well.
You mean you can't really have any conviction around a broken market?
With rates where they are right now, given how frozen things are in places like America, it's difficult to make that call.
What would have to happen would be for benchmark borrowing costs in the mortgage market to drop by 300 basis points to start getting a real flood of any sort of activity in this. That seems unlikely in the near term unless there's something really significant that happens. So to this question, are we seeing any kind of restrictive effect based on a housing market that just is stagnant, that just isn't moving? Basically, people are just saying, oh, we'll just buy new homes and just deal with that problem once rates comes down. What if they don't? And that's sort of what I was speaking to. Higher for longer might be more punitive than anyone can really imagine.
Forced selling. Things would have to get so bad that you had to leave that job or you were pushed out of it, that you had to move state, you had to sell that house. Until you get there, why on earth would you sell it if you're sitting there with 2-3% mortgage rates for the next several decades?
Which is the reason why people are looking to the employment rate, because that essentially will be the catalyst for some motion in possibly a negative way.
Equities right now, positive 0.2%. Coming up shortly, Will Kennedy on the oil market from New York City. Your crude market right now, 81.79 on WTI. This is Bloomberg.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behaviour was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
The top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything.
From New York City.
In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
There are no direct risks to supplies, and that's probably what's made it very hard for oil to rally. The European and US demand numbers definitely are weaker. So I think all of that together just means that, crude's probably going to remain range-bound for now. Not much of geopolitical premium in the price.
And Rita Sen there, of Energy Aspects. Only a month or so ago, we were talking about triple-digit crude by Halloween. Do you remember that conversation?
We asked her about it, and we said, okay,
What did she say?
It's 2 days until Halloween. We're not probably going to get there. And she said the reason why is interesting. It's because of a lack of demand. It's not because of potential supply shocks that people see being percolated from this conflict.
We got to 95. Basically, it's the same
It's
just
thing.
short. I have to say, surprise for me, for most people, I think, the month of October. Let's take a look at crude right now. Brent's at about 86. WTI in the low 80s, just short of 82. The month of October down almost 11%. So you've got a terrorist attack on Israel at the start of the month, basically, the first week. All these calls potentially for higher crude prices because of the risk that we're going to see this conflict broaden out, perhaps. And crude goes the other direction, and aggressively so.
It doesn't make sense from a geopolitics standpoint. it does make sense in tandem with some of the decelerating economic data points. And that might be what people are hooking into, the fact that people might be traveling less, and that a lot of industries are maybe not generating as much, particularly with the manufacturing recession that we've seen in the U.S.
Crude up this morning, WTI 81.76 up by 1.5%, Brent crude 86 up by 1.4%. Will Kennedy with us now, Bloomberg Senior Executive Editor for Energy and Commodities. Well, can we start with October before we get our teeth into November? What did you and the team make of that move through October? What was that about?
I think you and Lisa hit the nail on the head, basically, is that two things happened. One, after the events in the Middle East at the beginning of the month, people were worried about a wider conflict. I think a lot of those fears have dissipated, that the situation is, of course, horrendous, but the fears that it might spread into a wider conflagration for now are down a bit. And second, as Lisa said, I think there's an increasing concern about the state of the global economy going into 2024 and what that might mean for projections for oil demand growth not being as strong as traders had predicted a few weeks or a couple of months back.
How much, Will, do you get the sense that volatility is going to be really high in oil over the next few weeks? There was a study in the Wall Street Journal over the weekend talking about always after geopolitical shocks, there is this incredible volatility that maybe people are a little sanguine about given the decline that we were talking about last month.
Yes, I think that's exactly right. That, you know, when you do get these kind of events, they are, by their nature, they surprise more. They're less open to analysis. They're more open to interpretation. I think that can lead to swings in the market. In that context, it's interesting that the Saudis are trying to steer a steady course. They, yes, they announced that they would keep their voluntary 1 million barrel a day cut into December, which I think tells you that they share those concerns about demand and that they're going to adopt this precautionary principle, which is to try and keep prices stable and steady, at least where they are.
This is kind of a delicate question, Will, but do you get the sense that a lot of Western politicians are turning a blind eye to a whole host of things in order to keep oil prices going down rather than surging up? And I think, for example, about Russia and how there are a number of reports about how revenues from oil have just been absolutely skyrocketing because sanctions are not working, but no one really wants to crack down too hard because that oil is offsetting some of the potential supply disruptions that people are worried about.
I think in the case of Russia, it is partly a blind eye. Clearly, they could seek to enforce the price cap more strongly. But the other thing that's happened is that Russia and its customers have built a very sophisticated...
I looking to trade Canadian dollar. I'm going to place an order to buy Canadian dollar. So if you would like to trade this pair, United States again Canadian dollar, I'm placing an order to buy at 136.38. Okay, I'm going to place order to buy at 136.38. Okay, let's hope it will get filled really quickly. So, and then I will tell you what we're going to do with our position. Okay, I just want to remind you that each pip equals in our trade 100 pounds. So if we will go down 1 pip, it means we're going down 100 pounds. If we're going up, it means we earn 100 pounds. Okay, please check with your broker how much broker pays you per trade, per pip, because this is day trading, and we will sell this position as soon as we will feel comfortable that we can place stop loss on it, and then if it will move lower, if it will get filled our stop loss, this is the point when we will close our position. Okay, I'll speak to you later. Look like we'll have to wait for a couple of minutes until we will get filled, and I'll let you know what is going to happen with this pair. Stay safe.
Demand for diesel and naphtha are type of oil that's used in chemicals is weak and suggests that the industrial economy in Europe is really not in very good shape at all.
How much is this really tied to a shift in the type of energy that people are using? Not just electric vehicles, but increasingly natural gas around the world.
I think the bigger problem, especially in Europe, is that Europe's industrial base remains quite hit by higher energy costs. Hasn't really recovered from the hit that it took in the energy crisis that followed Russia's invasion of Ukraine, and a lot of that demand from factories and the associated demand from trucking, a lot of that chemicals demand still remains very weak and hasn't really recovered. And I think the question in Europe is how much of a permanent hit there was to some of this demand.
Hey, Will, wonderful to catch up with you as always. Send our best to the team. Will Kennedy there of Bloomberg, leading what obviously we believe is to be the best commodity research and news team on the planet, but ultimately it is. Aramco, selling prices, Europe, down, getting slashed, Will's words. What's happening in Europe right now? Is that economy really starting to crack?
I think a lot of the data shows that yes. I mean, you're seeing that month over month. And earlier today, we got data out of Germany that did cohere with some of the weakness that people had been expecting. But in France, it was weaker than expected. Some of the data in terms of the economic generation, particularly for manufacturing, it hasn't been good. So then how long is that going to be a divergence to the negative while the U.S. holds up at the same time that there's also a manufacturing and the recession in the U.S.?
And we're all talking about central banks moving in the same direction at the same time. Synchronized all at once, the Federal Reserve, the ECB, the Bank of England. It's the ECB. Walk us through the approach we got from President Lagarde compared to Chairman Powell. How much daylight was there? And then compare what we're learning on the European economy versus the US and how much daylight is there. Does it make sense that one has the same approach as the other?
They're both buying time. The only approach that I can see right now is they're both buying time until there is a conclusive trend that requires a response. That is the only relevance right now between the U.S. economy that's showing a lot of strength, albeit weakening at a certain clip, versus Europe that's in downright recession and not seeing a lot of potential optimism to really revive. So at this point, they both just want time. The question is it really going to be the same kind of outcome that they're going to be facing in 2-3 months?
Well, this equity market loves a more patient central bank. Let's go through the scores. Your equity market positive by 0.2% on the S&P 500. Last week up by 5.85% on the S&P. On the NASDAQ, positive by 6.5%. We mentioned the KBW bank index a few times already this hour. I think it's worth doing it again. To see the bank index up 11%, the best week since November 2020, given what you're told continuously that really what banks want is a decent economy and higher rates, then banks get there and they have a terrible year until they start to get weaker data and maybe the prospect of lower rates and we absolutely rip off the bottom.
Which raises this question, how much conviction is there behind any of this trades? Remember when we were actually talking about SLUs and people were using that as sort of this common acronym that now people have all forgotten, right? Everybody was saying, oh, wait, just wait for those. They'll tell you just how much we're about to crack and everything's going to go away. And now we're on the brink of getting that and people are like, it's going to be fine. And if it really comes in deteriorating, but yields are going down, so maybe you can, it's so head spinning to try to get your head around this with some logic.
Chairman Powell. He's going to speak again this week. Are we getting anything from him at all? Is that just sort of him opening up some kind of conference, or is it a real direct speech on something?
It's a direct speech, but are we really going to get anything? What can he say?
He has the option to say nothing if he wants. It's one of them.
But what is he going to say?
You know, you get that second headline that says he has not mentioned anything about monetary policy.
Yeah.
Is that what happens this week?
He's going to have to mention something. Okay. But I don't really understand what he will want to say. Doesn't he like that he's
financial conditions are too easy now?
I don't think he's going to say that. You think that's going to happen? Yeah, I don't think so.
Just got a message on the Bloomberg, just says recency bias.
Yes.
There you go.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we could deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly, we want to be there for her, but where it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. This is a promising area.
Maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
The narrative is changing, and the facts are driving that.
There are deviations from the trend. The trend has been moderating.
It's good news that we have a strong labor market.
We are in a pretty good position with respect to productivity.
We expect the market to continue to rally into year end.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Let's get your week started live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Your equity market is positive by 0.2% on the S&P. Let's embrace the happy talk. After the biggest week of gains of the year so far on the S&P 500, Brett Ryan, Deutsche Bank, the Fed is done. Max Kettner, HSBC, Goldilocks is back.
Yeah, is this happy talk really driven by something fundamental, or just what you talked about earlier, recency bias, which is basically the new plastics? It's recency bias.
Sounds painful for you, Bramo, but I'm with you. I think a lot of people right now are frustrated with the idea that we're constructing a one-year forecast based on the previous week's price action.
This is such a frustrating moment. Can I just say that honestly, every week we have a new narrative. It's been narrative ping pong that we've been talking about all year. And suddenly people are changing their outlooks on a dime as every swing in price seems to happen. And is it happening on technical reasons? Is it happening on fundamental reasons? It is a nuanced picture with data giving you conflicting signals, and people are taking it and just writing whatever narrative they'd like.
We can have some healthy debate here. Barclays believe the Fed is not done. They're going to go early next year. They think the dovish term may have backfired based on a price action we saw last week. Morgan Stanley's Mike Wilson, still bearish, saying this looks more like a bear market rally rather than the start of a sustained upswing in the equity market. That's the debate we've got to have through this week.
The debate here is, and it really, you highlighted it so well, John, which is basically, are yields going down a good thing if it really comes with a certain degree of economic pain that has not been priced in? What are we understanding as being priced in at valuations with yields where they haven't been for more than a decade? These are all questions we can't answer. What are we going back to in terms of base rates? So people are basically just ignoring all the bad stuff, trying to look at the nuts and bolts, coming up with an opinion, and trying to sell it.
I'm still stuck in the previous month trying to work out why they were up. Was it because the data was good? Was it because of supply? before you get to work out why they're down, have we figured out why they were up in the first place so much over the previous few months?
We literally asked every single person who came on, why are yields going up so much? And pretty much every single one of them said, it's a confluence of events. How much is each one of them? We have no idea. I mean, it's like baking a cake, but not understanding what the different potential measurements are.
You just come up with this one. It sounds good. We'll run with that. All right, stick with it, Bramo. Equities right now in the S&P, positive by 0.2%. If you are just joining us, here are the scores in the bond market. Yields up by a couple of basis points, 459.32. Last week, they were down more than 26 basis points on a 10-year. On a 2-year, we were down about 16 basis points or so. So Lisa, the whole curve just shifting lower off the back of the Fed speak, the meeting last week, the data, payrolls on Friday, and the Treasury refunding announcement, which was, let's just say, not as bad as people maybe feared.
If you think this is a readjustment of longer-term benchmark rates and what the neutral rate is, I find that hard to believe. Whether this is people just basically throwing darts at a board and finding out when they can buy, it feels a little bit maybe more concrete. Maybe we'll get a sense this week of how things settle out with the quiet of not a ton of economic data. Monday, today at 2 p.m., I want to know what smaller banks, what regional banks are doing with the lending situation. The Fed releases its SLOOS, the Senior Loan Officer Opinion Survey for the fourth quarter. Does it confirm the slowdown that we've been talking about? And does it lead to a possible continued pop in shares that, yes, rallied 11% this past week, but otherwise have been completely battered? On the political front, we haven't even talked about politics. I mean, how do you come up with a parameter? We don't even know who's going to be running next year. The third Republican primary debate will happen on Wednesday at 8 p.m. in Miami. The crew so far that seems to be at least confirmed as of now includes Ron DeSantis, Vivek Ramaswamy, Nikki Haley, Chris Christie. The field is going to widen. Do we have a sense of who is sort of the front runner among the non-Trump potential nominees?
It's got momentum, Nikki Haley. You know who the front two on that screen is, Ron DeSantis, Nikki Haley, but one's got momentum, the other one doesn't, Nikki Haley. You said we don't know who's going to run. Yeah, for both parties.
I know.
Not just the one up on the screen. I've got to go back to that poll from the New York Times over the weekend. States like Michigan, Arizona, Georgia, Nevada, big leads for the former president. Nevada, listen to this, 52% to Biden's 41. You can make the case that's an outlier. There's 12 months to go. There's a risk associated with that by sitting here and saying that's an outlier, there's 12 months to go. You sit on your hands to do nothing and hope it turns and it doesn't.
My favorite part of that was that a generic Democrat, not named, was actually winning against former President Trump by 8 percentage points. That just gives you a sense of how it's really a referendum in some ways on Biden, at least right now. Meanwhile, Fed Speak does return, just in case you were missing it. Fed Chair Jay Powell will speak on Thursday. So here's the question. Will he be able to say anything? Will he want to say anything? Or is this going to be another kind of, you know, basically we're kind of trying to come up with a consensus between polarized members, so I'm not going to really say anything of too much conviction.
He's said enough, hasn't he?
I don't know.
The impression he said enough.
Yeah.
I think he said enough. Sarah Hunt, Chief Market Strategist at Alpine Saxon Woods, joins us now. Sarah, has he said enough?
Well, I think he's trying really hard not to say anything, so right now that's enough, right?
How did that work out last week?
Well, it worked out to the point where the market looked at everything and said, okay, we're done with everything, and so now we can feel better. I think the biggest tension is, are we going back to the zero rate policy that we had since the great financial crisis, which is part of what I think gets equity markets excited when they think yields are coming down, or are we going to stick at a place where those rates are a little bit higher? And that's the tension that you were talking about. And this up and down is, I think, looking for levels, and the market is trying to understand what that really means. But I think the relief rally that we got last week in the equity markets was definitely on the back of lower interest rates and the idea that the Fed is done, and next year we're going to start dropping rates.
Do you think it's a mistake to extrapolate out the improving sentiment we witnessed last week through the end of the year?
I think you're going to see some of that sentiment continue on the positive side because there's not a lot that comes in between, right? We had third quarter earnings and it wasn't terrible. It was actually quite good. The commentary wasn't so great, though, going forward. So now we've got this tension between next year earnings are supposed to be up 12%. Companies are telling us that demand is a little bit lower and they don't see the things as good as they have been in the rearview mirror. So that at some point that's going to have to come together. But through the end of the year is, I don't know. I think we could see some positive action through the end of the year.
You said that there's not a lot that happens between now and the end of the year. We do get a potential government shutdown. That's about 12 days away. We do get potential election color. We do have a conflict right now that's going on two places, two fronts. We've got what's going on in Ukraine and what's going on in Israel in the war with Hamas. How do you put that together and understand this at a time when people are just trying to look at earnings and things that make sense to them?
Well, I mean, this is the sad thing about the fact that the markets aren't always the economy and the markets aren't always what's going on. So they are looking through a lot of this action because they're not seeing that as being effective to them. Even the government shutdown, which was threatened in September, didn't seem to have a huge effect on what was going on. We'll see what happens if we get a longer one or a protracted one. That could be a problem. I think also the whole issue of Treasury issuance and not going so far out on the curve also didn't dump a whole bunch of supply in there. There's so many things that were happening at the same time, but I really think it's looking for what is the story going to be? Is it pre-financial crisis kind of interest rates, or is it post-financial interest rates? And therefore, they have to come down. And I don't know that that's the case.
One of the convictions that you've had so far this year has been with energy stocks. And I wonder, talking about the conflict that the war between Israel and Hamas, how that factors in, considering that we're likely to get more volatility in oil prices going forward.
Well, there used to be a much bigger spike in oil prices on volatility in the Middle East, and there was some this time, but I think some of that's already come out of this situation. I think that the continuum between the Russian crude getting on the market, but gas still needing to get to Europe, I think there's still a lot of room within the energy space where there will be companies that do well, but I don't think that until and unless you see that get worse, which none of us want to see, I think oil is being fairly quiescent here. And I think part of that is also because there's excess capacity in Saudi, and that helps.
What are the lessons from the massive consolidation we're starting to see between some big players picking up smaller ones?
I think that that's telling you they're all looking at a world where whether or not, my base case that we have a longer tail on hydrocarbons, they're looking at the perception by investors that this industry is going away. And so therefore, instead of going out and spending a whole lot of money doing something like exploring other places, they're just going to they're going to consolidate that industry so that they can withstand whatever is coming at it. And so that they can also start to put some more money into some of the other places that will be growth areas as opposed to just a tail.
Is this better for shareholders?
I guess it depends on what shareholder you are, right? And it depends on whether or not you got bought at a premium. Some of these mergers have not been enormously helpful to the acquirees, but I think that as a longer-term shareholder, if you can get those consolidation of cash flows and they give it back to you, which many of them are still doing in quite hefty dividends, then that can be helpful. But I don't think in the near term that's the best thing for
well, this is really what I'm asking. In the near term, where do I want to be? With the smaller players that might get bought out, or the bigger players that are going to end up being around for a long, long time?
Well, to the extent that there hasn't been a huge premium paid for those smaller players, it hasn't mattered much. Although the acquirers, like if you look at Chevron, that stock got hit on that acquisition. So you don't necessarily want to be in those because people are not looking at them like that's a fantastic ultimate strategy, even though it very well may be. Some of those energy mergers that happened several years ago that people couldn't understand ended up being good for the companies that bought them. But sometimes it takes a long time for that to play out in the energy patch.
How much are you finding yourself trying to justify why energy stocks will continue to do well even after the rally that they've had into a slowing economy?
So that's definitely a timing issue. And I've said before that sometimes you need to have some positions you can trade around, but I don't think you want to get out of energy entirely. If we're really going into a slowdown and the lack of demand is what's driving oil prices, which is why I think the Saudis are taking oil off the market, then you've got bigger problems than the energy patch, but it's going to be a problem for the energy patch as well, because those earnings that people are looking for are not going to come through if we're really slowing down. But it is going to be, it is more difficult for them to perform in a recessionary environment. But we've also had some real underperformance for several years and some real underinvestment. So there's a lot of different puts and takes there.
Over the past month, it seems like we've had about 6 narratives. Have you shifted anything fundamentally in how you're approaching a moment where maybe we've peaked out in yields, maybe we've seen the economy start to turn, maybe we're starting to see a little bit more of a coalescing around certain levels?
I think that the last month or so, we've been spending a lot of time really trying to think about what's going to happen next year, because what you really want to do is worry about where I'm going to be positioned next year and what we think is going to happen on the macro level and for markets and globally. There's a lot of things that we can't control. There's a lot of exogenous variables. We have no idea how the geopolitics plays out. We don't know what's going to happen with the government shutdown, but we can take a look and say if the economy does this, then this group of stocks is going to do better than that group of stocks, and where do I want to be positioned? And I think that that's where we've spent a lot of time. The zigzagging back and forth in the last week or so, no. I mean, that's, I was not surprised to see a rally. I was surprised to see it that strong. But if the tightening of conditions had done the Fed's job for it, it just undid the Fed's job for it. So where do we stand now?
Which is the point that Barclays are making this morning. I can sense the frustration from you and pretty much everyone sitting at home right now listening to this. It's almost year-ahead outlook time. Some of them have already been written. I can't wait to see how that consensus comes together, Lisa. for projections for 2024 when we can barely project past next week.
I completely agree. How often are you going to rewrite next year's year-ahead outlook?
Good luck. Never mind March.
I kind of love that. I think that there should be a revision, you know, and just sort of like a check to see how many
I always say revision
revise.
date is March. That's when you have to revise them. It's going to be a couple of weeks into the year. You know, like 2 weeks, 4 weeks.
That's what it was last year. It was a couple weeks, then we started to get the revisions in mid-January.
If you are just joining us, welcome to the program on the S&P 500 right now. We are just about positive. We're up on the S&P by 0.15%. Best read of the weekend for me in the Financial Times. It came from Jason Cummins, the chief US economist over at Brevin Howard. And he wrote this article, bond yields signal the end of the new normal. Sarah, he's calling it the new abnormal. The new abnormal, an era of higher and more volatile inflation leading to broad changes in the investing landscape. Is that how you're thinking about things?
I can't hear abnormal without thinking of Young Frankenstein, and that's not a good thing.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behavior was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
Slide hjemme. Slide better. You want to talk business? Meet me in the On-Board Lounge.
Our generation uses Ibotta to get cash back in everything we buy. We had to work for ours. You're getting your cash back everywhere. I can clean up my cash back myself. Oh, listen, the news.
Get 100% cash back this Thanksgiving.
We worked through the weekend on a stopgap measure. We recognize that we may not get all the appropriations bills done by this deadline of November 17th, but we are going to continue in good faith. And the difference between what we call on Capitol Hill a continuing resolution now and what we've dealt with in years past is that this would allow us time, and everybody understands, allow us time to continue this appropriations process. We're committed to bringing 12 bills to the floor.
The work continues, the division persists. That was House Speaker Mike Johnson speaking on Fox News over the weekend. Live from New York, welcome to the program. Your S&P 500 stacking up as follows. Here's the price action. We're positive here by 0.15%, looking to add some weight to a big, hefty rally last week. Biggest week of gains on the S&P 500 for the year so far. In the bond market, yields bleeding just a little bit higher by a basis point or two. Your 10-year 458.91, way off the highs, Lisa, from 2 weeks ago.
The volatility here is just sort of shocking, and the fact that we don't understand, to your point, why things went up so much in terms of how high yields went up, nor why yields are down so much, gives you a sense of just where we are and how difficult it is to say, well, actually now we've stabilized around this level. Is there any conviction right now out there from anyone you've spoken to or read from?
There's a hope that it can continue. This came from Standard Chartered. Eric Robertson wrote this over the weekend. If the US rates complex has peaked, then these asset classes are due a significant rally into year-end from short covering, if nothing else. He's talking about US equities, EM assets, and non-dollar currencies.
Don't you get the sense that people are just looking for ideas that within sort of the turmoil to be able to say something, but
Isn't
there's
that
absolutely
the
no
business?
conviction? I know, but at a time of such little conviction, they've got to change every week depending on what the parameters are. I mean, that's sort of how it feels right now at a very difficult moment.
If you were navigating stars under cloudy skies and you wanted some visibility, you get it this week with tons of Fed speak. You excited?
Oh, I'm so excited.
Chairman Powell a
That's
little bit
gonna be
later.
really good.
Looking forward to it. Always exciting. Joining us now is AMH down in Washington, D.C., our chief Washington correspondent. AMH, we've got to start with that poll from New York Times, Siena College. There are just big leads in key swing states, and it's not for President Biden.
No, it's for the former president, Donald Trump, although we should note that poll after poll does show that both these individuals, voters don't want to see either of them running or to become president. But when you look at this potential redo of 2020, what you see here is that the former president is leading in swing states. In five of the six that the New York Times Siena polled, the former president is leading. And Jonathan, it matches the Bloomberg News Morning Consult recent poll that also shows that Trump is ahead in swing states. And big issues like the economy, many of these voters say they trust Trump more than Biden. And also on things like national security, and this poll as well takes into the fact that we now have this new conflict between Israel and Hamas in Gaza, and they trust Trump more. So this is obviously going to be another big wake-up call for the Biden administration, the Biden campaign. But time and time again, you'll hear from the Biden campaign, and they'll say it is just too early. And at this moment, we are a year out, and we haven't seen the millions of dollars that we will see unleashed on the American people when it comes to both of these campaigns.
They say it's too early. Where on the calendar does it become too late?
Well, that's a great question. I think first we need to get through these primaries, right? One nugget in this poll that really stood out to me is the fact that former South Carolina governor, former ambassador to the UN, Nikki Haley, who is doing very well in terms of some of these polls in Iowa and New Hampshire, she's in this poll in the New York Times, she beats Biden more significantly than the former President Trump would. But also interesting, Trump does much better than, say, Governor Ron DeSantis against Biden. And today we're going to have the Iowa governor, Kim Reynolds, come out and endorse, according to the Des Moines Register, come out and endorse Governor DeSantis. So I think we need to see how the next few months play out. But, Jonathan, they really start to unleash some of these funds, and Biden has to start campaigning within the next 6 months. He's going to try to do that today. He's going to be talking about Amtrak. He's going to be talking about Bidenomics. But the fact of the matter is, he is also embroiled right now in foreign policy. And what we see time and time again in these polls, that it's the economy that voters want to vote on.
All right, Anne-Marie, when you talk to people on the record, in the administration, from the administration, they're going to say, there's so much time, it's all noise. What's the sweat factor off the record when you have conversations?
I don't think some of this sweat factor is even off the record. We heard from Senator Richard Blumenthal, the Connecticut Democrat, over the weekend, talking on CNN's State of the Union, their Sunday show, and he said, I was nervous before the poll, and now I'm nervous after the poll. People do recognize that time and time again, one of the biggest concern that voters have in these polls, and it's not just about the current president, Joe Biden, but also about the former president, just not in as big as the numbers you're seeing, but people are concerned about the age of both these individuals.
This will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Slice through the noise.
Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Any signs of success whatsoever?
We've seen a lot of frenetic diplomacy, not just on Israel, but also, Jonathan, now we have Secretary of State Antony Blinken making a surprise visit to Baghdad. Today he's in Turkey. So there's a lot of pressure. At the moment, what you hear from the Israelis is they are not going to stop until they get rid of Hamas. Of course, their issue, and administrative officials have spoken about this in public, is that Hamas has time and time again used schools, use refugee camps, use hospitals to place their infrastructure, to place their leaders. But as every day continues and bombs continue to attack Gaza, and you see pictures of these civilian death tolls rising, you see internet cut off, you see humanitarian aid struggling to get through, the calls are going to become much more louder from not just the president, but also other members of Congress and other leaders in the United States and around the world to pressure Israel for a ceasefire. Right now, what the U.S. is pressuring for is a pause for humanitarian aid, and potentially we may see one.
Anne-Marie, just over the weekend, we saw some pretty big protests, pro-Palestinian protests in the nation's capital, where you live, where you are. How difficult was it to draw a distinction between those in that group who had perhaps justified criticism of Israeli policy and those in that group who were just pushing blatant anti-Semitism?
Well, this is a big challenge. And this is what Senator Bernie Sanders was talking to over the weekend. He does not want to see Palestinian children die. And he says this is an incredibly complex problem. And what the issue is if you're at a protest, it's really hard to do nuance. And especially as even that chant that a lot of individuals will talk about at a protest, many take that as calling for the destruction of the state of Israel. And obviously, many in America, many in the Jewish community view that as anti-Semitic. And frankly, it is. But then you have individuals like Rashida Tlaib who says, no, I am just calling for peaceful, humanitarian, peaceful rights, human rights for Palestinian people. And that is why this is so challenging, Jonathan.
AMH, thanks for the update. Anne-Marie, down in Washington. We've got to talk about some big numbers in Washington this week. $48 billion of 3-year notes get auctioned. Later this week, $40 billion of 10-year notes, $24 billion of 30-year bonds. That's a lot of supply. Amanda Lynham of BlackRock, up next.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley.
5-day winning streak on the S&P 500 about to become 6. Your equity market looks like this. We're positive on the S&P, on the Nasdaq through most of this morning, up 0.1% on the S&P 500. On the Nasdaq 100, up by 0.2. 5-day winning streak, the longest since June. The weekly move we saw yesterday, the biggest weekly move going back to November. Bramo on the S&P 500.
Just in honor of our guest coming up, if you take a look at the analog within the debt space, the credit space, we saw almost 0.75 percentage point plunge in yields of high yield bonds over 3 trading sessions. Just to give you a sense, it's crazy if you take a look at just how wild and violent some of these swings were, and that is sort of the equity analog in credit.
Are we about to get whipsawed? Barclays. This note from Barclays this morning, getting a ton of buzz. I'll share the lead paragraph with you. The Fed held steady, shrugging off strong data on the pretext of tightened financial conditions, but this dovish turn may have backfired. They go on to say, with financial conditions easing significantly this week amid some softer data, we retain our view that data momentum will force another hike. Their call is early 24. It's January now, not December, but still, you come out and you start endorsing tighter financial conditions, doing some of the work for you and backing away, and all of a sudden, guess what? It's not doing the work for you anymore.
I love the chess game that seems to transpire between the market and the Fed. It's always kind of fun, where basically the Fed's trying to get the market to do the work for them, and the market's saying, well, I see you, so I'm going to get ahead of you, and I'm going to move to where you're going to be, and then you end up in this circle that's really fun for everyone trying to come up with your head outlooks. It's really good.
The headline from Barclays, the Fed is caught in a circularity loop.
See?
Just random. There you go. All right. In the bond market, 2-year, 10-year, 30-year. Let's get to the bond market. Treasuries through 5 2 weeks ago, back down to 459.53, up 2 basis points on a 10-year. Lisa also pulling back on a 2-year as well, 486.97. Last week, has the bar for more hikes got higher? Yes. Here's the question: has the bar for cuts got lower?
That, I think, is the key question that people are going to look to, and what you're seeing in the market is yes. That seems to be the implication, especially given the fact that this Fed seems to be seeing something that the rest of the market maybe isn't, which is the reason why people are curious about the SLOOS later today. It's really fun to say that, the Senior Loan Officer Opinion Survey.
Is that why you're repeating it?
SLOOS.
Okay.
It's not that fun.
Later.
Anyway, but they're just curious to see whether that tightening is kind of in the pipeline and is going to get bled out in the long and variable lags that you love.
Okay. The epicenter of our world. Bonds. Yields down. Dollar weaker. Euro stronger. Best week for the euro against the dollar, that currency pair. Back to the summer, the month of July. 107.51 on this currency pair, positive here by 0.2%. Under surveillance this morning, US Secretary of State Antony Blinken in Turkey, trying to stop the conflict in the Middle East from spreading. Blinken also making an unscheduled stop in Baghdad over the weekend after meeting with the president of the Palestinian Authority in the West Bank. This was Blinken's first visit to the West Bank since the October 7th attacks by Hamas, and the pressure, we've been talking about this all weekend, Lisa, all morning. The pressure building on the administration is getting bigger and bigger.
And the inability maybe to put the pressure on the Israeli government, also a real point of question here, especially given the West Bank and some of the violence there that Tony Blinken said was absolutely unacceptable. They need to really tamp down on that from the Israeli side. Whether there's going to be some sort of response, again, unclear what kind of influence they have.
And that's foreign policy, foreign affairs, international politics. Let's talk about things domestically. Some good news from Republican presidential candidate Ron DeSantis, expecting a key endorsement today from Iowa Governor Kim Reynolds. Bloomberg reporting the governor will make the announcement at a rally today as former President Donald Trump maintains his lead across the Republican field. The Iowa caucuses are on January 15th. GOP candidates will take to the stage later this week. Third debate taking place, Bramo, on Wednesday.
You know, this to me is going to be a theme all for the rest of this year and also early next year. Are we really going to get a rematch of Trump versus Biden, or are we going to see new entrants? And I think that maybe after a number of these debates, there will be a question about whether former President Trump, A, needs to take part in some of these debates, and B, what the feasible kind of outlook is for this election with people who are actually electable, given the unpopularity of those two candidates.
Let's just round out the greatest hits of stories that frustrate you. Here's the last one, the third one. House lawmakers working over the weekend on a stopgap measure to fund the U.S. government beyond the November 17th deadline, according to House Speaker Mike Johnson. Johnson previously floated this new funding deadline of January 15th. Still waiting for details on that. So we're playing this game into what, this deadline in the middle of November?
I feel triggered right now. I'm not sure. I mean, this is just all triggering stuff.
This last story may or may not have been deliberate.
Well, the other ones are equally frustrating. This one is frustrating because it's such an unnecessity, like a lack of necessity to understand that we're going to get another shutdown. What I think is interesting is that Mike Johnson actually has taken a more moderate and conciliatory tack than a lot of people had expected, and is talking about pushing that deadline to early January in a more meaningful way. He had a different tone than some people had expected in the talk shows over the weekend.
I think we're all excited about this story for the next couple of months, aren't we? Amanda Lynham joins us now, head of macro credit research at BlackRock. Amanda, don't worry, we're not going to be talking about that. I do want to talk about supply, if we can start there. We've got $48 billion of 3-year notes this week. We've got $40 billion of 10-year notes. We've got some 30-year bonds, $24 billion worth. These are big, big numbers. That's Treasury supply. What's happening with credit supply going into year-end?
Good morning. Thank you both for having me. So as you know, credit supply had a bit of a flurry of activity in September. It calmed down in October. I do think with this tentative stability in the Treasury market that corporates, CFOs, and treasurers may look to move ahead before the year-end seasonal slowdown. It will be an important test for the market how this Treasury supply is digested, but as we know, the Treasury Secretary guided us towards the front end of the curve and not so much in duration in the refunding announcement last week. But I actually think if nothing else, the past several months have shown corporates that this can be very episodic in terms of these windows opening. And so given that we know the maturity walls are coming up, I think for corporates, it's better to issue early rather than late. We're expecting a big week in the IG market this week. I think expectations are a little lower in high yield, but I would not be surprised if we surprise to the upside in terms of those expectations, because I think it's just prudent for CFOs.
Which speaks to kind of the opportunism that one syndicate desk told me about last week. He messaged me as soon as we saw this rally, and he said, everyone's trying to come to market. I've gotten 15 phone calls. Everyone's basically lined up. Is this going to be bad with credit spreads widening in this sort of counterintuitive way because we've got more supply?
Yeah. I think the appetite is there, and I think we've had such light supply, especially in high yield year to date, and 22 was a record low level, that I think the appetite for the market is there. I think where the real risk is at that lowest quality cohort of the CCC market, that kind of lowest quality rung of high yield, which are CCC issuers. There, I think we've seen some enhanced pressure where it's weak results coupled with refinancing needs have really pressured those capital structures, and even on this swift rally in high yield spreads that we've seen over the past few trading sessions, CCCs have rallied, but they've lagged on the way in. And I think it's the market telling you that there's an appetite for a certain quality cohort in the credit market. IG, I think, is there in most market conditions. High yield is a bit more tentative, but for that lowest quality rung, I think it's very case specific and very idiosyncratic.
Are people kind of just pricing in perfection here?
Well, with high yield spreads below 400, it's hard to argue that there's much risk premium added into the market at the moment. I think what we're seeing is a lot more focus on selectivity from our credit investors. So thinking about asset allocation between high yield and leverage loans, sector selection, issuer selection. I think where high yield spreads are at the moment, the path of least resistance is probably a little bit wider in terms of choppiness with some of the headline risk ahead of us. But again, as we've talked about before, where yields are, it's really difficult to see kind of high yield spreads breaking out in this range of much wider from here, because every time we tried to reach 440 last week and we kind of snapped back in. And so there is a bit of a tug of war between fundamentals and technicals, and even the most vulnerable fundamental pockets of the market have been the best performer, like leveraged loans.
You mentioned the decision set between loans and, say, high yield. Help our audience understand what goes into making that kind of decision and whether that's changed in the last few weeks.
So it has changed in the last few weeks for a few reasons. One is if you think we're at the end of the rate hiking cycle, if you think we've seen stability in long end rates, you might think that the bulk of the loan outperformance is behind us at this point. And indeed, that yield pickup that leveraged loans were offering over high yield bonds has narrowed. So what we are seeing is a bit more interest, say, even within capital structures of investors saying, okay, well, I'm in the loan, should I rotate into the high yield bond? Or given the fundamental pressures of this higher for longer rate environment that we're expecting, are loans disproportionately impacted by that because they've been contending it with it for a longer time? Again, we don't view fixed rate bonds as immune from that in many instances, but I do think on the margin, given the strong performance of loans year to date, there is some refocusing on, okay, is the bulk of that loan performance behind us?
Breathe some life into that just a little bit more. We saw a big equity move last week.
Yep.
If you're looking at and I know it's unique and idiosyncratic, but ultimately just give us the 35,000 foot view. If you're looking down a capital structure right now, is the bias to be higher or lower in it?
Actually, I think the high end of the high yield market has actually outperformed the low end of the IG market. So it's not as clear cut as saying be underweight high yield versus IG. There are a lot of nuances there. I do think for choice, I would prefer to be higher in quality within high yield. In IG, I think moving down into that BBB cohort is a relatively nice place to be. For the most part, the vast majority of those corporates are committed to maintaining investment grade ratings. You are picking up a bit of a spread pickup relative to the highest rate cohort. And I think that's important in this current environment, especially if we don't get a severe downturn in growth.
So I don't mean to be overly basic about this, but when you take a step back, I do wonder if we do coalesce around this higher for longer kind of idea. Yep. Does it make sense that we're not going to get any kind of major default cycle, either in public credit or in private credit, if we're looking at benchmark rates that are 5 percentage points higher than when all of these companies were borrowing in bulk not so long ago?
It's a great point, Lisa. So we are seeing a modest uptick in defaults. We're at just under 5% in the U.S. when you combine high yield and leveraged loans. That's well off the rock bottom levels of 2021 and 2022. Do we break out to the levels that we saw in COVID, 8.5%, 9%? I think barring a severe downturn, I don't see it. Part of the reason is that corporates have entered this period in a really strong position. The other part is that the investor appetite, to your point, John, is there. And then third, I would say corporates are actually shifting to a more balance sheet friendly posture. So we haven't seen a lot of debt funded M&A. We haven't seen a lot of debt funded share buybacks. They're still investing in CapEx, still investing in debt repayment in terms of uses of cash. But I do think corporates do have some discipline. I think the real risk is that if there's a severe downturn in growth coupled with just a capital markets freezing such that these corporates don't have access at any price, I think it's difficult. As for the private credit point, historically we look at losses between the two markets, and private credit losses have held in better than public credit losses. Part of that is because the enhanced flexibility that those corporates have. We think that holds true, but I think the point remains we're expecting an ongoing normalization higher in losses across all those asset classes. Not extreme though.
Given where we know where the maturity wall is,
yes,
can you identify what would be the least optimal time to have an economic downturn? And is that what's basically on the horizon now?
So I think probably the biggest risk is that if corporates try and time this opportunistically, they let the year end play out, they think the environment will be better in the first half of 2024, and then we have some sort of shock, whether that's geopolitical, unforeseen risk contraction. We're watching bank lending very closely, although that has actually played out, I think, a bit more benign than we would have thought. That is the risk. I think that if corporates try to be almost too strategic about the timing and they cut it too close, we saw that in the financial crisis where some corporates were shut out. So that's why I think if I'm a CFO or a treasurer, better to issue early rather than late.
To Lisa's point, maybe we get a lot more supply in the coming weeks. and months based on what we've seen develop over the last few weeks. Amanda, thank you. Always great. Amanda Lynham there of BlackRock. If you are just joining us, welcome to the program. Your S&P 500 positive here by 0.2%. Your bond market yields up by a couple of basis points, 459.53 on a 10-year yield. Let's go through that supply again, Bramo. We're going to get 3-year notes, $48 billion worth. We'll get them tomorrow. Day after, $40 billion of 10 years. Day after, $24 billion of 30-year bonds.
Is the fire over?
I know one of the reasons you're here in Marrakesh and in Africa, because you see the enormous potential this continent has as a source of renewable power for electrolysis, right? That's the process by which hydrogen is extracted from water. Tell us about Africa's potential.
Africa's potential is the best in the world, and it's Africa's shot now. It's Africa's turn. What will stop Africa rightfully taking its turn will be lack of progress on technology. Companies and governments around the world choose Fortescue because we are the world leaders in technology, world leaders in next era electrolyzer design, cables, solar, all the tech which is moving our world on from having to rely on dinosaur era fossil deposits of oil, coal and gas to simply today's era of machines which make machines to harness all that beautiful renewable energy and give all the mobile energy, all the fixed energy this world could ever need by many times. Those countries who resist that are denying Africa their opportunity. And I'm saying, stop it. Let's get in behind Africa.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Every human life is tragic, Palestinian or Israeli, it doesn't matter. We act according to international law. We make every distinction that we can make between civilians and terrorists. This is tragic, but we cannot allow Hamas immunity just because they hide behind civilians. We want to separate between the two and strike the terrorists.
That was Michael Herzog there, the Israeli ambassador to the United States, speaking on CBS over the weekend. From New York, welcome to the program as we kick off a brand new trading week. Your S&P 500 shaping up as follows. Equities pushing higher through most of this morning, up by 0.2%, pushing much, much higher through last week on the S&P 500. The gains last week, Lisa, close to 6% on the S&P.
And it was driven by banks, it was driven by utilities, it was driven by also big tech, it was driven by all of the winners as well as some of the losers. Broad-based, kind of continue. And honestly, this morning, it seems like people are getting conviction that maybe this has lasting power.
Note just dropped from Evercore. We expect Fed speakers this week will try to lean against any continuation of the rapid retreat in yields and easing of financial conditions. Barclays talked about how circular this is. That's going to continue maybe this week.
So what are they going to say?
No
that
idea.
Things have gone too far? We're targeting 4.8% on the 10-year. Please get with the program. I mean, honestly, at a certain point, how specific do they have to be versus just be agnostic and say, we don't know exactly what's going to happen?
Neil Data of Renmac just wrote in as well. So if you stay tuned, I'll give you the Neil Data take on things in about 5 minutes' time. Look out for that. Let's start in the Middle East. I'm pleased to say that joining us now is retired Lieutenant Colonel Daniel Davis, the Senior Fellow at Defence Priorities. Colonel Davis, thank you for being with us, sir. I know something you'd like to talk about is something we'd also like to talk about. Maintaining a troop presence, the United States in places like Iraq, in Syria. Can you help us understand whether the benefits of doing that outweigh the risks?
Well, I argue and have for many years, not only does it not benefit us, it gives us nothing but a strategic vulnerability. In 2019, in May 2019, President Trump then tried for the third time to say, I'm going to withdraw all our troops from Syria. And I was an advocate of that. And then I went on Fox News and I said, look, we need to get these guys out of there. He needs to succeed with that because all it does is provide an opportunity for some of these Iran-backed groups or other kind of Islamic groups to just target them. If you take those troops out, then we have no point of vulnerability. If those troops were there and doing something of value to the United States and they were necessary for our security, then it might be worth the risk. They aren't. There is no value to our country at all. They are almost purely a vulnerability. And now it's going to be harder to take them out because people are going to be afraid of, oh, but it'll cause, that people will think we're weak or that we're forced out. Look, they'll say whatever they want to say, but you can't leave American troops there and just leave a ticking time bomb until one of them gets killed. And then you have to actually decide whether you're going to strike possibly even Iran and get us drawn into a war. Nothing is worth that.
Colonel Davis, would you acknowledge that the decision to withdraw them now, since the events of several...
Okay, guys, I'm going to cancel order to buy Canadian dollar. As you can see, it took a while. This is day trading. I was not expecting to wait for very long for this order to get filled. We will, as you can see, it changed, basically it's moved up and there's not much point to hold it on. So when you will, if you decided to follow me, please cancel this order and wait for next good chance opportunity to trade Canadian dollar. Otherwise, stay with me. If I will see any other chances to trade whatever on a screen, I will let you know. Okay? I'll speak to you later, guys.
Should get involved if Hezbollah goes against Israel, or if anything else happens with Iran, then we have to go in with there. We want to deter them both, and that much firepower is causing a deterrence on both. But it comes with a risk, because if whether someone through miscalculation or a foolish decision or a rogue actor in the region, and there's plenty of them, if they take action that then causes us to have to use that, then that could be the very thing that sparks us into a war. So it's a double-edged sword.
And Colonel, it's coming at a time where there are a lot of questions around morale of our troops. And I'm wondering from your vantage point, how you see that evolving right now as the U.S. gets more involved in conflicts, whether it's in Israel or potentially on the border of Ukraine.
Well, look, I'm sure that everybody who volunteered was very similar in one regard to when I volunteered to serve, and that is we just said we want to join our force to defend America. If we're attacked, we want to defend our interests, and if necessary, we're willing to even lay our lives down for that. There's no one that I know of that would dispute any of that. What we didn't do is say, hey, we want to put our lives on the risk for some other government, like Iraq. We have troops on the ground in Iraq that are helping Baghdad. They're not helping us. Or in Syria, that's helping the SDF, Syrian Democratic Forces, not us. And or ad infinitum, there's so many places where it's helping other countries, it's not helping us. And it's not a good thing for, like, say, the family members. When people are thinking about joining up, do you really want to have your kid go in and maybe just be a pawn in the middle of the desert? That's not even necessary for our security. It definitely has an impact, and it's not a good one.
Colonel Davis, every Monday we talk about another weekend of intense diplomacy between Secretary Blinken and a range of countries. I know you've got your own personal thoughts on where and which country we should maybe be talking to a whole lot more. Can we talk?
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Like, please, like, really actually tune in. I desperately need an audience.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Help the Hamas side or Hezbollah, anything against the Israel, you have some real problems if that starts to happen.
Daniel, appreciate your perspective this morning. Let's do this again soon. That was Daniel Davis of Defense Priorities, the retired Lieutenant Colonel. Elisa, pressure on this administration from, as we've said all morning, all directions.
It's all directions. It's within each party, because there is a question also of the importance of preventing a wider altercation in the Middle East and the U.S.'s role and historical role in doing that, and how you do that while maintaining support and actually not ending up on the wrong side of the conflict.
Now, I promised you one thing, didn't I? Neil Dutta, the view on the
please,
Federal Reserve. Interesting view from Neil, different. Unemployment has increased while wage growth has slowed to a pace consistent with their underlying inflation objective. What's changed for the Fed is they can credibly point to the labour market data of late and say they have achieved a rebalancing. Put differently, they can't use the job market to stay hawkish. That's your view from Neil this morning. That alone, reason to think about the Fed surgically cutting interest rates.
That's Neil Dutta.
That's Neil Dutta of Renmac.
That is a real flip in his view, where he was talking about the potential for a real increase in inflation. So now my question to him, and we'll have to get him on to actually answer this, is does that mean that he is taking back some of this belief that we are in a new higher rate regime that's eventually, gonna have some sort of consequence, or is he basically the sort of bad news that he was expecting down the line?
Well, cutting back to what? That's a question we can ask. I think he's raising a point that we can now think about surgically cutting interest rates, which is not going any further, but ultimately reducing them in line with this drop-off in inflation pressure, which is, I think, where the market is going into 2024.
Surgical?
You can ask him what he thinks that means. Mandy Zhu of CVO Global Markets joining us in just about 5-10 minutes' time. Your equity market on the S&P, positive here by 0.1% on the S&P 500, following the biggest weekly gain on the S&P of the year so far. We are on a 5-day winning streak, which could become 6.
This is Bloomberg.
Story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
this right here is the shadow fleet. To actually see clandestine behaviour was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Look at the cracks that are developing. I think there's a decent chance that the Fed may have to cut a lot more.
We do think that's still a heightened risk environment.
We are seeing pockets of weakness.
I'm talking about a hardish landing. I really don't see how the economy can continue on in this way.
Whether it's soft landing or hardish landing or hard landing will remain to be seen.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. TK back in a couple of days, getting your week started with equities positive once again after a massive week of gains on the S&P 500, higher by close to 6%. And the dovish language continues this morning. Deutsche Bank, Brett Ryan, the Fed is done. We've heard that from HSBC as well. Goldilocks is back. This from Neil Dutter of Renmark. The doves can take out the hawks in December at the Federal Reserve.
Which raises this question, how do you do that without loosening financial conditions so substantially that you have to go the other way? This is the cyclical kind of moment that we're in that is head spinning. And if you're waking up and saying, are you guys going to keep going with this? Yes, unfortunately we are, because we have no other choice. This is essentially the cards that we've been dealt. And essentially that is where the Fed is going to be stuck between a rock and a hard place in how they message.
Financial conditions are too tight. Yeah. The moment you say that, what happens?
Boom.
Yields plunge, equities rally aggressively, credit spreads tighten, and the dollar weakens.
Exactly.
That was last week, wasn't it?
So essentially, are they going to be gaming the market? Are they going to be market timers the way that the Treasury Department seems to be? And you have basically two market timers that are trying to pin a market in between what particular range. And do we get that kind of situation over the next couple of months?
So this week we don't get data, we get Fed speak.
Correct.
Right, including Chairman Powell. Evercore out with a note this morning saying we expect Fed speakers this week will try to lean against any continuation of the rapid retreat in yields and easing financial conditions. Once you start doing this, you can't put it back in the bottle. The toothpaste is out of the tube, isn't it? You go week to week trying to manage financial conditions. Is that really going to happen?
It could very well happen. It sort of depends on whether we have some sort of lodestar with respect to the data. And so far, we've had a real sort of divergence with confusing and noisy data that is typical at the end of a cycle or close to the end of a cycle. So the question is, when is that moment that we reach a tipping point where the data speaks for itself and there is a clear trend? And until then, are we going to be playing, I don't know, pickleball?
Pickleball now. Okay. Why don't we just go with James Athey's turn?
I'm trying to sort of diversify.
James Athey of Aberdeen just called it
ping pong.
No, he called it narrative table tennis, didn't he?
Well, same thing.
Yeah, ping pong, same game, but missing a word.
Well,
just
whatever.
Narrative ping pong, if you want to call it that.
I think we should do pickleball because I actually saw a pickleball match this weekend, and I could understand a little bit more.
You went to watch a competitive one?
No, I went to the park and there were
like
pickleball
walk past one. Were you tempted to play? I hate the noise. The noise does my head in.
Yeah, it's a different kind of ball.
I hate the noise.
Why? But it looks kind of fun though, doesn't it?
There's people playing it at like 8 in the morning. And if you live by one of those courts, just back and forth, no thank you. Big rally in the bond market last week into this, a massive slate of supply coming up. We'll get 3-year notes, 10-year notes, 30-year bonds. That's a lot of supply coming this week, Lisa. Just going through the numbers, 48 billion, 40 billion, 24 billion, respectively.
Arguably, this is what led off the rally, and arguably this is what was underscoring it for so much of last week when it became clear that the Treasury Department was very attuned to the market dynamics in a significant way. So here's the issue. If we get a disruptive kind of auction, how problematic is that going to be for the idea that maybe we've seen the peak in yields? That, to me, will be the most instructive aspect of this particular week.
Jeff Yu, BNY Mellon, earlier this morning on this program said we could retest yields from where they were 2 weeks ago. Doesn't think this is over.
And other people would agree with that simply because if you take a look at inflation, it's not going away. That said, are we seeing potentially the softening in the labor market data that could justify people making whatever argument they want? This is going to be fun.
It's going to be fun. Is that what you call this?
Well, I mean,
my
message
board this morning on my Bloomberg just lighting up with recency bias.
Exactly.
Just extrapolating out the last week price action, which is bonds rally, equities rally, yields drop, dollar weakens, credit does well, spreads tighten, and all the good stuff.
In fairness to the recency bias, and to be completely clear, people who have traded on a theory of recession have failed.
Yeah, that hasn't worked.
Right. People who have traded on the theory that 60-40 would work again also have failed. People who have traded on the idea that eventually big tech would roll over with higher yields, that's failed. So what theory has worked other than recency bias and riding momentum?
60-40 was awesome last week.
Exactly.
Just everything. Just
it's either awesome or terrible.
Equities look like this on the S&P 500, positive here by 0.1%. Big rally last week on the S&P and on the Nasdaq. Big rally in the bond market too. Yields aggressively lower. This morning higher by 3 basis points. I think we can call it 460. Surprise of the year so far, there have been many. Surprise of October. Just the fact that crude was down as much as it was in October, Lisa, it's kind of stunning. Down by something like 11%. This morning we're higher by a single percentage point to 81.52.
Again, try to come up with some sort of theory. Geopolitical risk, oil prices higher, failed. I mean, again and again, we're just seeing one narrative after another torpedoed in actuality because of all of the different myriad factors that are playing into this. It is mind-spinning.
Let's try and come up with a theory with Mandy Zhu, Vice President, Global Head of Derivative Markets Intelligence over at SIBO Markets. Mandy, good morning to you.
Good morning. I'll take a stab at the narrative ping pong.
Or pickleball, or whatever Brammer wants to call it. Okay.
Pickleball.
Max Kettner, HSBC, said this morning, Lisa quoted it, I'll cite it right now, the MOVE index is the new risky asset fear gauge. What would you say back to that?
So certainly bond volatility is the highest across asset classes right now, but I don't think it is the only measure that investors are looking at. And obviously, I'm not just saying that because I work for the SIBO, but I would say the VIX index, more so than any other, is what traders have up on their screen. But to be fair, I think right now we need to look across multiple asset classes, rates, equities, credit, right? We recently launched the credit VIX indices to give investors a better gauge to measure credit volatility. All of these are important asset classes to watch for as we kind of go into the potential end of cycle, as we talk about recession versus soft landing.
Is there anything about the price action and moves we saw last week that would give you some indication as to whether it's sustainable or not?
So to me, the price action of the past, not just last week, but past 2 months have been extremely telling in terms of what the pain points are in people's portfolio. And it's not to the downside, right? The pullback that we saw in September and October were very, very orderly. And that's because coming into the fall, the consensus investor expectation was for a pullback. And when you really saw the pain was last week in the snapback rally, right? We saw people actually scramble for that upside because they weren't positioned for it. So if you look at, for example, S&P put call ratio hit almost a 1-year low as people were kind of buying those upside calls to really get that upside exposure that they don't have in their portfolio.
I love this, by the way, that the pain trade is when things do too well and that people got knocked out because there was a rally. Well, I mean, this is sort of where we are in this moment of upside down and downside up. But my question to you is, have we washed that out? Are we done with the positioning that causes the pain trade to be further upside?
I don't think so. I think, again, we talked about the narrative ping pong, but I do think the consensus, and even though economists have shifted to soft landing, I think if you talk to investors, everyone is still so bearish, and the positioning, to me, it's going to take longer to really wash out than what we saw last week, and that's why we're seeing that durable demand for those upside calls in the S&P.
When we talk about upside,
yes.
Are we talking big tech upside? That basically is what people have not loved because they've believed that higher yields might take away some of that valuation, that people are being forced to buy those once again?
I think part of it, there certainly has been, I think one of the distinguishing features of this year's price action has been the incredible sector dispersion, and we talked about the narrative ping pong. The ping pong between sector leadership, right? Last year, tech down 40, this year tech up 30, 40%. That changing sector leadership, that high dispersion in the market is part of the reason why volatility in the equity market at the index level has been so muted. It's because of those wild swings that we're seeing at the sector and the stock level.
How correlated have the bond and stock moves been? In other words, is there just a direct read through? Lower yields, stocks rally, higher yields, stocks meander because people aren't positioned in them too much.
So if we zoom out from just the past week and look at over the past year, it's been incredibly unstable. So that's, I think, the key feature is the equity bond correlation has not normalized to what people are used to. And because of that instability, I think is one of the reasons we're seeing more and more people gravitate toward equity specific hedges, so options, right? Because if fixed income is no longer diversifying your equity risk in your portfolio, you need to look at more specific hedges. So, buying those S&P puts or other types of hedges. I think that's kind of been the trend, and that's why, option volumes have been hitting record highs all year.
A note that just caught my eye from Citi, Andrew Honhorst, he said, soft patch, not soft landing. There's a difference. He says, rather than a steady slowing in job growth and inflation, our near-term projections suggest a temporary soft patch. Elevated inflation is likely to be more evident in upcoming data. Last week's reloosening of financial conditions also argues, in his eyes, against the moderation and activity and inflation. Mandy, does that argue that we should be much more nimble as we work through this? Lisa kind of mentioned this, and we were quite snarky about it earlier on in the program.
Yeah.
It's difficult to make projections for the next 12 months. You can't cling to a theory at the moment when everything seems to change. It's painful in bonds. You'll get whipsawed in one direction, and the next week, whipsawed in the other. Does that argue to be nimble, and what does that look like from your perspective?
Yeah, so I alluded to earlier, so absolutely, the heightened macro uncertainty means that investors do need to be nimble, and the way they're doing that is through using options, right? And the way that I like to explain is, if there's no uncertainty and stocks are going up, you just buy the underlying, right? You just buy the Delta One, instrument. It's when you're uncertain, when you want defined risk reward, right? You want to know what you're at risk of losing if you're wrong. That argues for using options, right? If you buy a call option, going into the trade, the max that you can lose is the premium paid. I think that's why, again, in this uncertain macro environment, even though it hasn't translated into higher levels of VIX being 30-day measure of uncertainty, that long-term uncertainty has definitely led to more and more people using options to kind of define that risk reward to help manage that portfolio volatility.
You touched on it there just slightly.
Yes.
When you talk about volume in options, are we talking about 0 day to expiry?
No. So people often think, okay, everything's coming from 0 day to expiry options. Volume across all tenors are growing higher, but obviously 0 day has been the fastest growing segment.
You've made the argument that's not something we should worry about.
No, and because it's balanced. So people who make the argument that 0 day options are what's driving the market, they look at the gross volume, the notional volume, and they say, well, look, it's 500 billion a day. Of course, that's what's driving the market. But if 50% of that is buy, 50% of the customer selling, then there's net zero impact, right? So the balance of that trading matters, and what we see is that it's incredibly balanced, and because that's the case, there's actually very minimal market disruption.
Mandy, this was great. Always is. Mandy Zhu of SIBO. Mandy, thank you.
Thank you.
If you're just joining the program, welcome. Your S&P 500 positive here by 0.1%. Yields higher by 3 basis points. Your 10-year 460.57. Tons of dollar weakness last week. 107.42 on that currency pair right now. We're positive there by 0.1%. You've started something, Bramo. I'm not sure what you've started, but Jim Bianco, try and explain this to me. Andy Roddick, former #1 in 2003 US Open winner, called pickleball diabetes tennis. Do you want to explain to me what diabetes tennis is?
Not particularly.
No?
I mean, I think maybe, I have no idea. Maybe because you don't have to move around as much. for tennis. I don't know what else it could possibly mean.
Actually a quote from Andy Roddick. Jim Bianco's got to explain himself.
He's going to have to explain himself. He can come on and explain it better than I can. I just know that you don't have to run as much. That was one observation, because the courts are smaller, so arguably maybe you don't have to be as fit. But I'm not going to say that because it looked fun to me. And I know you have a personal problem with it because you don't like the noise of it.
I've had a lot of people write to me as soon as I said it. It's the noise. People don't like the noise.
Can you actually hear that from your apartment?
Not from mine, but as I go on walks sometimes, I don't like it.
And it triggers you?
I wouldn't say
disruptive.
I'm not triggered by it, but I find it disruptive, yes. On an early morning walk on a weekend, Bramo, and you go past the pickleball court, that noise, I don't need that in my life.
It's like it's a slapping sound rather than the sort of like
and is it really
hollow bump.
Exercise? Is it?
I mean,
sort of like, you know,
have you ever played ping pong? I can work up a sweat in ping pong.
Can you? All right. And pickleball.
I've never played pickleball, full story.
Coming up, stay tuned. Michael O'Leary, Ryanair CEO, joining us around the table to talk about their recent numbers, plus the latest from Boeing and whether this company can get enough planes from that company. Looking elsewhere, looking at your equity market right now, there is a lift once again, up by 0.1% on the S&P 500. The rally in the bond market last week replaced with just a little bit of a sell-off. Yields higher now by 4 basis points. Lots of supply from Treasury this week. Your 10-year 460.98. Live from New York City this morning. Good morning.
I think we're going to have a good landing with respect to the confluence of financial variables we're talking about. We have a consumer in our country that is reasonably in good shape. The reality is that you got winners and losers in this economy, and the goods sector that people accelerated purchases during the pandemic aren't maybe doing as well. But if you live in the experience economy, who most of us do, it's doing quite well. If you look at our planes are full. Our planes are full almost everywhere you go, particularly internationally.
That was Ed Bastian, the Delta CEO, speaking with Alex Steele and Guy Johnson last month. Michael O'Leary with us around the table, the Ryanair CEO. Michael, I wish people could see your face as Ed Bastian was speaking, just to get some reaction. It's good to see you. Good morning.
It's great to be here, John, Lisa. Good to talk to you again.
Well, thank you, buddy. You've had earnings out this morning. We've been talking about this dividend of 400 million euros. We've got to talk about this relationship with Boeing. I want to share a couple of quotes with you and then try and get some clarity. So you said in the last week, if anything, it's getting worse. I would have been reasonably confident up until about a month ago that we'd get 57 aircraft by the end of June. I'm not confident.
We heard from your CFO this morning, said the worst case scenario is that we'll end up with growth of 47 aircraft next summer instead of 57. Help me understand where things are. What did you want and what do you think you're going to get?
Yeah, I mean, in our case, Boeing are contracted to deliver us 57 aircraft by the end of April 24. In other words, 57 additional aircraft for summer 24. At the moment, that has slipped by the Spirit production issues in Wichita, Boeing's own production issues in Seattle. I think now it looks like they'll leave us maybe 10 short by about the end of June. We're hopeful we get 45, 50 aircraft by the end of June. And we said to Boeing, we're not taking planes in July and August because, frankly, we're too busy. But we're reasonably hopeful that we'll get 45, 50 aircraft from. They will leave us short. I think that's inevitable at this point in time, which means we'll have slightly slower growth next summer, but we'll still add 45 aircraft. It'll still be enough to enable us to grow traffic from 183 million passengers this year to just over 200 million passengers.
Is there a number you have in mind whereby you would have to cut capacity for next summer?
There isn't. I mean, we haven't yet announced what the capacity will be next summer. As we said this morning, we have 90% of our summer 24 capacity already on sale, strong forward bookings, good pricing. But we can't commit to the last 10% until we get a better picture from Boeing. I speak weekly with Dave Calhoun. I think he's doing a good job in difficult circumstances. I have less faith in the management in Seattle, but I think, we're working closely with them. We have our own people in Seattle, we have our own people in Spirit and Wichita, and anything we can do to expedite these deliveries we'll do because growth is so strong in Europe.
What is it about the management in Seattle? What are they getting wrong?
I think there isn't enough focus there on a daily basis on how do we get with these aircraft out. Everybody is kind of wringing their hands, blaming Wichita. A lot of the issues are in Seattle as well. They need a more crisis. I would like to see greater crisis management in Seattle and greater focus on quality control. I don't understand how Wichita, Spirit and Wichita were able to have this succession of production problems if Boeing's quality control was up to speed.
Do you have options?
Options in terms of?
What do you do if you don't want to work with Boeing anymore?
No. Let's say we want to work with Boeing. We're Boeing's biggest customer by a mile in Europe. We're a committed Boeing customer. Now, I would buy Airbus aircraft if they were 5% cheaper per seat than Boeing. But Boeing continued to beat Airbus on pricing. The 737 MAX is a phenomenal aircraft. We now, this summer, we've flown 125 of the MAX 8 aircraft. We're carrying 4% more passengers, but burning 16% less fuel. They're transformative in terms of the engine and aircraft efficiency. We've ordered 300 MAX 10s, which will allow us to carry 228 passengers per flight and burn 20% less fuel. So they're making great aircraft. It's just they're not making them on time or delivering them in time.
Is it fair to say, though, this is a relationship you're stuck with regardless of what it delivers next year?
I mean, yes, we're committed to Boeing. If you look around the world, the aircraft manufacturers, Airbus are no better than Boeing at the moment. Airbus are way behind on their deliveries too. You have the Pratt & Whitney engine, which is going to be a real crisis next summer across the A320 fleet in Europe. The Pratt & Whitney engine is going to ground a significant number of Airbus aircraft next summer. So all of the aircraft manufacturers are challenged. We're a very proud Boeing customer. I think Boeing will get its act together. It's just taking a bit longer than we had originally hoped.
In the meantime, how far can you jack up prices if capacity is constrained?
I think that the real issue for Elise is not how much will we jack up prices, how much will Lufthansa, Air France, IAG or BA keep jacking up prices, and the answer is a lot. Eurocontrol estimate this summer Europe's operated about 94% of pre-COVID capacity. That includes us growing by 25%. So take Ryanair away, Europe's still at less than 90% of pre-COVID capacity. That's not changing next year. The aircraft manufacturers are delivering aircraft late. The Pratt & Whitney will mean 5-10% of the Airbus fleet will be grounded. And consolidation. Lufthansa will buy Alitalia, somebody else will buy TAP, and there'll be even less capacity on offer.
Okay, so this is good news for you because you don't have to really have to try too hard to be the lowest cost aircraft while still raising prices. How much are you going to raise prices next year?
We're price passive, load factor active. I think what's happening is how much, if Lufthansa, Air France, KLM will drive up fares, I think by a double-digit number next year, it'll send even more people in the direction of Ryanair. People want to keep flying, families want to go on holidays, they just don't want to pay Lufthansa's outrageous prices. So I think fares that next year, my operating assumption is fares will go up by a low double-digit percentage again through the summer of 24. It'll be the third summer in a row we'll see double-digit fare increases in Europe.
This is the first year, the first time that you're initiating a dividend.
Yep.
It's a £400 dividend. It is the first time. Does this mean that you have nothing else to do with that money?
Essentially, yes. You know, it's not the first timeve done it. We've done special dividends and share buybacks. We've done about $7 billion in share buybacks and special dividends. But we're clearly generating a lot of cash at the moment. We've paid down about $2 billion in debt. We're down to our last $2 billion in bond debt. We'll pay that down over the next 3 years, and we're generating more cash than we know what to do with. We have specific requirements. Firstly was to do pay increases for our people who worked with us during COVID. Secondly was to pay down the bonds, and thirdly is to fund aircraft deliveries. But we're running out of the existing order. We take the last aircraft in December 2024. The first of the MAX 10s doesn't arrive till January 27. So we're looking into 2 or 3 years where we have effectively very little uses for cash. And I think it's a commitment on our part. We'll return to shareholders. We won't squander it the way many other airlines do in M&A or buying hotels or whatever, or as Delta would do, giving monstrous pay increases to its pilots over the next 4 or 5 years. We need to keep our costs low, keep our efficiency high, and keep passing on unbeatable airfares to our customers.
Do you think shareholders then can expect more of the same over the next few years?
I think so. As long as trading continues, who knows what's going to happen in Ukraine or in the Middle East, but as long as we get a reasonable wind on trading, then I think we will continue to be very cash generative and we will return large amounts of cash to shareholders.
It's hard to know what is going to happen in Ukraine, in the Middle East. I don't expect you to give us a projection. I do want to understand, though, are you seeing things slow down in any way, shape or form when you start to see these things escalate? Anything at all?
No, I mean, well, we saw the initial, when Russia invaded Ukraine in February 2022, or 22 or 3, I can't remember. There was a sudden downturn in all of our traffic into Poland, Romania, those countries. It recovered after 2 or 3 weeks. We've had to suspend, we're suspending all flights. We've about 30 flights a day into Tel Aviv. They've been suspended until Christmas. So we do want to see those scenarios resolve themselves. But the ultimate underlying trend across Europe, we've locked up everybody for 2 years of COVID. They all want to go back traveling. Families want to go on holidays. We've just completed the October midterm break. We were still full. And I think what people want is to travel more, but there's only 90% of the pre-COVID capacity. So in Europe, you've constrained capacity, enormous demand, and that is resulting in very strong pricing, not just for Ryanair, but for all of the airlines.
Are you noticing any trade down? I hate to describe it as trade down from BA to Ryanair, but are you noticing anything like that?
Not at the moment.
Okay.
But I think it's inevitable if the next year or two, if consumers are under pressure, I think you'll see the Lidl and Aldi's of the supermarkets, IKEA will do very well, and Ryanair will do very well.
So what about using some of the cash to make the experience nicer for people who might be frustrated with the
Lisa, it'd be impossible to make the experience on Ryanair any nicer. New aircraft, on-time flights, the fewest cancellations of any airline in Europe. I mean, I don't understand why people pay such ridiculous airfares for a horrendous experience on Lufthansa, who lose your bag, miss your connection. On Ryanair, it's efficient, it's cheap, it's on time, and it is beloved
like a man that might have lost 184 million people once upon a time.
Did you? Did you lose luggage?
I had to do on a road show a year ago. I had to fly from Frankfurt to Zurich, which is only about a 1.5 hour flight.
Sure.
They stung me for €900 one one way in economy. And I was sitting at the back in the middle seat in front of the toilet on an Edelweiss A320. I mean, €700, I could fly all year round on Ryanair for €700.
Michael, it's good to see you. Thanks
Great
for
to see you,
joining us.
John. Lisa, thanks.
Fantastic,
Thank
as
you
always.
so
Great to see you.
Michael O'Leary there, the Ryanair CEO. Next hour on Bloomberg TV, here's the lineup for you. Tony Dwyer of Canaccord Genuity, Stuart Kaiser of Citi, Laurie Heinel of State Street as we start a brand new trading week following a stellar week of gains in this equity market. Equity futures positive here by 0.1% on the S&P 500. Live from New York City this morning. Good morning.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is the show about? It's a show about money, power, culture, pop business. We're going to ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Earnings season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers
It's
first.
a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power. We're going to make more money. We're going to make more money. And we're going to make more money. You're making bank, and I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
The biggest of the rally of the year last week, and it continues today. Welcome back. This is Bloomberg Surveillance. John went off to prepare for his 9 a.m. hour. We can see a lift to the market after last week. Incredible rally, particularly in banks, as we've been talking about, in addition to the NASDAQ. Right now, you also are seeing ongoing dollar weakness, 107.4 on the euro-dollar spread. You're seeing S&P futures come back from some of the earlier highs, up about just 0.1%, and yields very quiescent here, kind of inching upwards as the session grows older, now up 4 basis points, 4.61%. A real question on whether we've seen the highs underpinning some of the confidence or lack thereof among market participants. We talk about the geopolitical risks, we talk about the political risks, and we haven't really talked about the potential government shutdown that is 12 days away should there be no agreement in Congress. Emery Herdern joining us now to discuss Bloomberg congressional correspondent. Emery, is there actual progress geting made on how to stave off some sort of government shutdown at a kind of tumultuous time, both geopolitically and domestically from an economic perspective?
Well, it feels like deja vu in Washington because we literally just had this debate, and it cost Speaker Kevin McCarthy his job. But there does seem to be a honeymoon grace period for this new Speaker, Mike Johnson. And what you see him trying to do, and what he talked about over the weekend on Fox News Sunday, is that they're going to continue to work to advance these single appropriation bills, and a lot of them are conservative. So this is one way, in terms of a strategy he has, is really to pacify or placate to the hard right flank of his party, and then potentially they're not going to get all those aproppriation bills done by next Friday, November 17th, when there could be a government shutdown, when the government runs out of funding, and then he'll have some wiggle room to bring a continuing resolution to the floor. How he does that is going to be interesting. He at one point mentioned this latter approach, so funding the government in a staggered way, potentially funding certain agencies at certain dates. He's also talked about going till January 15th or even April 15th to give his caucus and to give all of the House of Representatives more time to fund the appropriation bills. So these are the potential options we can see in the coming next 2 weeks before the government would end up running out of money.
It raises a question, especially ahead of Wednesday's debate. We're going to be hearing possibly what the candidates' proposals are for the economy, where they would like to cut, and how much bond yields are very much in the forefront of their minds as they think about how to reduce the deficit. What do you expect, and how focal do you think the economy will be in Miami on Wednesday at 8 p.m.?
Well, I think it'll be top of the agenda for this debate on top of foreign policy, because that is what is happening right now, and that's what the polls continue to show are on top of voters' minds. The economy seems to continuously be the #11 issue, especially when it comes to inflation. And whether or not it's the latest New York Times Siena College poll or it's Bloomberg's poll with Morning Consult that focuses on these swing states, what you see in the data is that there is a trust deficit amongst voters with the Biden administration. So you're going to see all these GOP
candidates want to attack the current administration when it comes to the handling of the economy. They're going to want to talk about cutting spending. Where they want to cut is, of course, a small slice of the pie, right? No one's going to want to talk about cutting defense, and no one on that stage is going to want to talk about cutting entitlements. That does not garner good views from voters. One thing, though, Lisa, that could potentially separate some of the individuals on the stage, and we saw Governor and former Ambassador to the UN Nikki Haley do this, is some will potentially start to attack the Trump administration for raising the deficit by nearly $8 trillion as well. So I think that will kind of be a marker. Who is willing to go after what the Trump administration did in terms of the deficit as well, and not just go after the current policies of the Biden administration?
Emery, are people still saying that it's almost a certainty that the matchup next year is going to be Biden-Trump?
It does feel like more and more people are coming out and saying, this is the election we didn't want, but this is the election that is forced upon us. Most voters in the polls want to see fresh, younger faces, and it looks like they're just getting a redo of 2020. But again, we are a year out, and there's still a lot of debates, caucuses to go. Potentially, it can change on the Republican side more so, not on the Democratic side.
Emery Herdern, thank you so much, as always. We've been talking all morning about where we are economically and whether the Fed is responding to an actual slowdown or whether it's going to be a head fake, given that we still see inflationary pressure and we might see a patch of softness leading to yet another sense of strength as well as inflation early next year. One of those people who thinks that perhaps this might be a head fake is Veronica Clark, economist at Citi, who joins us now. Veronica, how much are you pushing back against some of the optimism that we've seen in the rip-roaring rally in the Treasury market last week?
Yeah, I mean, I think the rally that we've seen is a response to policymakers last week. Of course, we had the Fed and the Treasury, but what hasn't changed is, we really haven't seen much in the economic data that have changed. It was just a couple weeks ago where we got almost 5% GDP growth in Q3. We did have an employment report on Friday where there was a bit of a downside surprise, a bit of an increase in the unemployment rate. But overall, it does still look like pretty resilient activity, and especially, unfortunately for the Fed, pretty resilient inflation also.
So, Veronica, when you say that the data isn't as soft as people expect, how do you push back against, for example, the labor market report that showed significantly fewer jobs than people previously thought, as well as several consecutive reads of jobless claims going up at a faster pace than people expected?
Yeah, the overall headline miss to payrolls I wouldn't read too much into. We do know that there were about 30,000 striking auto workers that dragged on payrolls this month. Those will be added back to payrolls in November. I'd say the most interesting thing maybe on Friday's data was that we have seen a rise in the unemployment rate over the last 6 months or so. We could look back, if we're in a recession this time next year, we could look back and say maybe this was an early sign of it. But I wouldn't read too much into that now. The level of the unemployment rate is still very low. We are definitely watching the claims data. We have had this increase in continuing claims. There are some seasonal adjustment issues with that series, and the fact that initial jobless claims are still very low is, I think, more important, but we're definitely watching those initial jobless claims.
Do you think that the Fed is making a policy error then?
Yeah, it's really hard to say at this point. I mean, we don't think we're getting any more rate hikes from the Fed, but we could get into a couple months of data now where we've had softer inflation data June, July, August. We've had one, the September CPI print where the details of that were pretty strong. We think we're going to get some pretty strong underlying details of upcoming 3 or 4 months of inflation data. It could look pretty uncomfortable maybe early next year. It just doesn't look like inflation is sustainably slowing at this point. But I think as you're leaving rates high for a while, at some point that should matter and should slow things down.
We're speaking with Veronica Clark of Citigroup, and this has been a view that you guys have held for quite a while, and you've actually switched your view on the Fed recently based on some of the recent rhetoric saying that you don't think they are going to hike rates again. What gives you confidence that inflation is going to pick back up given that consumers are clearly showing a strain and they are selectively moving away from certain areas and pushing back on the margins against prices going up too much?
Yeah, I mean, fundamentally, I think the underlying resilience of inflation has to do with the labor market. And we did have employment cost index data out last week. Also, we had a lot of data last week, and that is still running. Wage growth is still running at a pace, somewhere around 4 to 5%. That's going to be more consistent with something like 3% inflation, 3 to 4% inflation than 2%. So I think that's fundamentally it. But in the upcoming couple months of data, we do a very detailed component by component forecast, and there is probably probably some strength. We're not going to get a drag from used car prices as much in the next couple months. Things like airfares that could look a bit stronger. All of that to say, we might be exiting a soft spot for inflation in the next couple months.
Which raises this question of what will break. If the Fed isn't going to raise rates further, as you now believe, does that mean that inflation is going to stay sticky and higher than the Fed would like and get less sort of grounded than it has been so far? Or are you saying that something will crack in the meantime?
Yeah, I think it's actually both of those things. I can see inflation staying high until we get the real recession in the U.S., a real slowdown. And that can come from, rates, are at restriction, contractive levels. I mean, that's probably true. At some point, leaving rates, in that territory for longer is going to weigh on activity. We would have less confidence in the real soft landing. I think that, drag on activity does look like a recession at some point, and that's what breaks inflation finally.
At 2 p.m. today, we get the SLOOS, the Senior Loan Officer Opinion Survey, which a lot of people looked forward to 3 months ago, and now people are basically saying, well, we haven't really seen credit tightening at some of these smaller banks to the extent that we thought that we would. Are you expecting that this report will show something different, and that this maybe was why the Fed had a different tone at last week's meeting?
Yeah, I've heard some conspiracy theories that maybe the Fed knew something in the SLOOS that we don't know yet. I think it'll probably show that, credit conditions are contractionary. People don't want to borrow, people don't want to lend, and over time, that is what weighs on activity. I don't think we're going to see anything too shocking necessarily, just more of the same. And, as, credit conditions are tight, at some point that will matter.
Veronica Clark of Citigroup, thank you so much for being with us, as always. And here with us, our SLOOS correspondent, Michael McKee, who is going to cover all things regional banking. SLOOS correspondent. I know that you have coveted that for years, and so I want to say congratulations for being promoted to the SLOOS correspondent. But I'm curious how important it is at a time where there's very little other data and where people seem to be clinging to narratives that change like sand sifting through some kind of timer. I'm coming up with a terrible analogy.
It's a quarterly report, so we haven't heard from the bank folks since basically July. We'll get the new SLOOS today, Senior Loan Officer Survey. But it doesn't really matter because the Fed's already got it, and they've already acted on what they have seen. Raphael Bostic spoke with us on Friday, and we asked him about it because they had already seen it, and he wouldn't give us the details, but he said, I don't need to read. He said, I read it, but I didn't learn anything because bankers have been telling me for weeks now that they have been tightening credit. So you could assume that the SLOOS today is going to show tightening credit.
So John was asking me earlier this morning, are we going to hear anything new from Fed Chair Powell? Is he going to actually say anything? Does he want to say anything? Does he want to push back against essentially a loosening in financial conditions that we've seen over the past week? Do you think that we're going to hear anything?
I don't know that we'll hear anything definitive. The market reprices on a moment-to-moment basis, so we may get something that sends bond yields up or down. But it doesn't really matter because we're 6 weeks away from the next meeting, which is what a number of Fed officials have said on Friday, basically, when they started doing their rounds of TV interviews and speeches, is why do we need to tell you what we're going to do now when we've got 6 weeks, 2 CPI reports, a PCE report, and another jobs report coming up? Let's just wait and see.
Michael McKee, stick with us. Our SLOOS correspondent saying things like we may get something that sends yields up or down, which is sort of how it feels because we don't know which direction given day is going to be a violent move one way or another. Right now in the market, you can see the earlier rally in equities pull back just a bit, but still around 0.2% gain. The euro gaining versus the dollar. The dollar weakness really standing out. And earlier this morning, we were taking a look at the potential for gold to rally. Chris Verone was saying that is an indictment, frankly, on the attractiveness of some other currencies. And 10-year yields right now, I'm looking at an increase of more than 4 basis points, 4.61%. Michael McKee still with us here as we parse through the lack of economic data this week. We also do get from a whole host of Fed speakers. Do we have a sense of whether they're okay with the action, the sort of violent volatility that they have seen in benchmark yields? Is that actually helpful in and of itself, just simply because there is a dampening in risk appetite that comes along with such volatility?
Yeah, I think you put your finger on something that may be slightly important to the Fed, and that is the idea of the dampening of activity because of the volatility may cause people to pull back a little bit. But you want a good indicator of what the Fed is thinking, look at the fail rate for trades. And if the fail rate doesn't go skyrocketing, then they're not going to worry because it's not a systemic issue. The idea that the market was letting the Fed, was doing the Fed's work for it had some nice credence for a while, and now it doesn't necessarily. But do we know where bond yields are going from here? You look at the story on the Bloomberg this morning, fascinating story, about how much of this rise in bond yields that we saw over the last month was due to massive hedge fund shorting. And so that's the kind of market thing the Fed can't do anything about, can't plug into their models, so they'll just look through it.
Do you think that they're going to be watching the auctions, the $112 billion of Treasury auctions this week?
They'll be watching. What's funny is, to me, is that we're seeing this enormous, there's $330 billion worth of Treasuries going out, another $40 billion, they say, in corporates. And everybody's saying, who's going to buy this stuff? But nobody's saying that nobody will.
Right.
It'll get through somehow.
It'll get through. It's just a question of what price it'll take. Michael McKee, thank you so much for being with us. Coming up, Ashley Allen of Franklin Templeton on the state of the consumer, a key question as we look to next year.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behavior was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
The top names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Today, my outlook is that we're going to stay on that slow and steady. And if we continue to do that, then I think where we are now will be sufficiently restrictive to get us to the 2% level for inflation. But there's still a lot that's going to happen between now and even the next meeting.
That was Raphael Bostic, Fed president of the Atlanta Federal Reserve Office, speaking with our own Michael McKee last week, just taking a look at what's going on in markets, a little bit of lift. Remember, last week was the biggest rally that we've seen in equities so far this year, one of the biggest rallies we've seen in bonds, very much a cheer based on the fact that maybe the Fed was not going to raise rates even more from here. Just taking a look at some specific stocks on the move. Bumble, the dating app, is moving downward, lower by more than 6% after the CEO, Whitney Wolf Hurd, said that she would step down from this company. She did found it. A real question around dating apps and how much more popularity they can gain given the boom that they saw over the past 5 years. Now questions around consolidation, et cetera. Hilton, those shares are kind of fluctuating back and forth, now up 0.4% after announcing an agreement to buy Blue Green Vacations, basically valuing this company at full speed, including all sorts of other potential premiums, 111% premium over Friday's stock closing price. And Birkenstock, those shares lower by just a touch after HSBC analysts said that the valuation, quote, feels a bit tight, unlike the shoes, which typically are quite loose. But I digress. digress. Moving on. Joining us now, I'm so glad to say, is Ashley Allen, Corporate Credit Research Analyst at Franklin Templeton, who can weigh in maybe on Birkenstocks. But more importantly, thank you so much for being here, because to me, the big question really is how resilient is a consumer after people have been saying that they're running out of their savings month after year after month. Have we reached a point where you actually are seeing evidence of that?
Maybe. And I think it's been maybe for a few months, to be fair, but I think we find ourselves in a really interesting situation right now, especially following 3Q earnings. We just heard from a handful of staples companies, from restaurants. Consumers are still spending, especially on some things that they'll want to indulge in, whether it's coffee, sweet treats in the grocery store. So the data is backward looking, so we have to keep that in mind. But up until this point, again, resilient has been the word that economists have said over and over. They're still showing up to spend on the things that make them feel good.
How much in some of the earning calls that you've been tracking and just some of the communication that you've had with corporate officers about what they see going forward, how much do they see this continuing in a durable fashion, just based on how much wages are increasing and the fact that the labor market is strong?
I don't think it's durable, at least at the same level that we have sustained thus far. A lot of the resilience that we've seen on the top line has been driven by price. Volumes, let's call them flat, plus or minus, on either side, both in kind of the restaurant space, but also in staples, if you think about the CPG companies in the grocery store. Volumes have kind of flatlined. So where they can, consumers have technically been pulling back. From a volume perspective, they're consuming less. Companies have just realized that they can still benefit from taking price. That likely can't continue forever going forward.
Well, a lot of people will argue that a lot of the household balance sheets look pretty good.
They do.
So if people want to lever up to get a latte, a double, mochaccino, they can do that. Is that what we're actually seeing, that people are just continuing with indulgences, but levering up to do so?
Potentially. I don't necessarily, it's always a maybe, right? I don't necessarily think that they're leveraging up to buy their latte, but I think if you have to look at the bigger picture macro, if you think about millennials, broadly speaking, who maybe are waiting to buy their first home, if you can't do that right now, I would argue that, spending $7 on a coffee isn't going to impact your ability to buy a home the same way the Fed would in regards to their rate policy. So I think from a consumer perspective, it's less so about them leveraging up, but a bit more about the bigger macro picture, what they are spending on, and how they're supported by jobs, to be frank as well.
So as an investor, do you recommend then consumer discretionaries that are the small luxuries in life that people seem pretty committed to?
Yes, so there is something called the lipstick effect, which we've seen before, specifically, in regards to beauty, where women will still spend on small luxuries to make themselves feel good during times of economic stress. I think that same the pattern or thesis could easily be applied to sweet treats. So think about, Oreos or cookies that we like as well as just the occasional splurge in regards to dining out. And whether that's at a full price restaurant, maybe you're okay spending $20 on your fast food meal that one time. They will indulge, especially during times of economic stress.
Do you buy the whole Ozempic argument?
Not yet. It's TBD. I do think these drugs are really powerful for the individuals that they were originally designed to help, maybe those with type 2 diabetes or who are severely overweight and obese. But consumer habits really die hard. And I think that it might take more than Ozempic, at least in its current form, to change those patterns.
So zooming out, we were just speaking with Veronica Clark over at Citigroup, and she was talking about how they expect a soft patch now and then a reacceleration in inflation because a lot of consumers just keep accepting prices where they are. Do you agree with that, just based on sort of a company-specific kind of analysis?
I think that if consumers, can keep their wage gains that we've seen recently, if those can be persistent, there's a good chance that they will continue to accept the price gains. I think it's a matter of who's going to blink first. Is it coffee? But as long as they're supported by jobs and some wage gains, I think they'll continue to spend.
Which raises this question: when you talk to corporate executives and they can pass along these costs, are they then hiring more people?
No, because at the end of the day, corporates are also responding to markets, broadly speaking, they're trying to recover the margin that they lost over the past 18 months or so when inflation and input costs really got out of control. Margins became compressed at that time. Profitability was hammered. They've benefited these past few quarters from those price increases in conjunction with falling input costs. Now, to be fair, those costs haven't completely reverted, but profitability has been strong from them. And for the most part, this is very idiosyncratic, but companies have been rewarded when their bottom lines, of course, have expanded or reverted to pre-pandemic levels.
So just zooming out, to wrap this all up, I guess there's this question of whether some of the legacy retail companies and whether the legacy service companies can continue to operate and thrive based on their capital structures and a borrowing cost that was a lot lower from another era that they were going to have to refinance at a higher rate, whether they are still credible companies to invest in a current environment. Are you basically saying that yes, because they're able to pass along those costs to consumers that have continued to really go for the products that they're selling?
Yes, they've been able to pass along the cost, but the maturity wall, broadly speaking, has been pushed out for several corporates, including those in retail in discretionary names. And so, you know, they have balance sheets these days and the cash flow to support, you know, the interest expense that they have now. In 3 or 4 years, when their maturity wall comes due, we'll see where we are and we can address it at that time. But at the moment, balance sheets are strong, the cash is coming in, they can make their payments, and they're passing along those higher prices.
What are the strongest segments of retail right now?
Oh, it's a great question. Broadly speaking, beauty is a segment that's continuing to do well. Historically, pet has been a segment that's been strong, but we have seen some weakening there. It's probably a bit of a post-pandemic trend that's reversing, but
people are sick of spending their entire paycheck on Fido. Ashley Allen, thank you so much of Franklin Templeton. We really appreciate that. One of the biggest questions really going forward as we try to understand how much we can continue a trend where people can splurge and continue paying up on some of these prices. To weigh in on all of that, coming up on Bloomberg Television at 4:30 p.m. Dirk Van de Putte, Mondelez International Chief Executive Officer. I'm sure that he will have plenty to say also about Ozempic and how much that's really going to challenge their balance sheet going forward. There's been quite a bit of pushback that maybe people have overplayed just how much that's going to change people's trends. Right now in markets, you are seeing a bit of a pop, continuing the rally that we saw last week. Yields, though, are inflecting just a touch higher, which raises this question: have we truly seen the peak, and are we going to see stability, especially with $112 billion of Treasury auctions, 3s, 10s, and 30s this week? On Thursday, we do hear from Fed Chair Jay Powell. Right now, that euro strength is softening just a touch, coming back 107.36, and we are seeing a bit of a lift to crude, but this has been one of the most unpredictable areas of the market in the face of a conflict that does continue in the Middle East. Crude prices up about 1%. From New York, this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we could deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. And this is a promising area.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
Let's get your trading week started. Live from New York City this morning. Good morning, good morning. Equities high, a 5-day winning streak. Can this become 6? The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming off the back of the best week of gains this year. Equities inspired by a major bond market reversal as incoming data clips the wings of central bank hawks. We begin with the big issue. The bulls catch a break.
We have seen a rally in both equity markets and the bond markets.
Kind of a relief rally after such a dismal couple months.
There's a bit more reason for investors to be a bit more optimistic.
Now we know that major central banks are on hold.
The Fed was probably done with rate hikes.
The payrolls report was picture perfect.
Just confirmation as to why the Fed should be done.
You couple that with the announcements that we got from the Treasury.
The markets are just taking off.
We do have a recipe for a pause, if not a further fall in yields.
We expect the market to continue to rally into year-end.
We should still be prepared for a larger pullback or mild recession coming.
There is space for negative surprises in the earnings picture for next year.
If the economy proves to be more resilient, if inflation proves to be more stubborn, the bond yields could go up once again.
It's not going to be a straight line for the stock market or rates after this big move.
There are still risks and problems ahead.
Joining us now to discuss, Citigroup's Stuart Kaiser, Tony Dwyer of Canaccord Genuity. Tony, it's been a morning full of happy talk. This from HSBC. Goldilocks is back. We are pro-risk. Tony, have you changed your view on this market?
John, as you know, I haven't changed all year. I don't expect change now. I'm in the recession camp. I don't think there's anything that's refuted that. What you just had is, we're always so great at being right in hindsight. But, what we had coming into last week was really a historic oversold condition using one of our favorite indicators, the weekly stochastic. And then you couple that with a bond market that had 3 identifiable catalysts, and you get a counter trend rally, which is quite frequent when you're in a broad bear market.
Stuart, beyond positioning, what did I learn last week?
I think you got confirmation from the Fed that they're on hold, and you got more information that the labor economy and services spending remain strong. And then thirdly, I think you got a nod from the Treasury that they're respectful of what's going on in bond markets, and they're going to try to manage that risk as best they can.
Sounds like you think, Stuart, this can continue. Is that right?
100%. Yeah, we do think the market's going to move higher into year end. You know, that's been our view for the last couple of weeks. I mean, the bear case has been a little bit of a whack-a-mole. You know, people tell us data's too strong, you can't be bullish. Data's too weak, you can't be bullish. You know, the fact is the underlying U.S. economic data remains strong. As a simple rule of thumb, I think as long as the U.S. labor market and services spending holds in, you can run long equity risk. If that comes under pressure, then you want to get out quick, and you want to be very cautious about when to re-enter.
Tony, what do you say back to that?
Well, I agree. Historically, when you have a weak or a negative August, September, October, you have an up end of the year, November, December. Our case is just that last week was so vibrant. You know, we had put out the call for a rally that it pulled forward a lot of what might have happened later in the year. So I agree with Stuart. I could see it grinding higher a little bit going into year end, but I think ultimately you need a lot more, and Stuart and I have different frameworks, right? I can't get a long only institution that trades for 3 years out quickly. You know, his client base and some of ours you can. So what I've got to do is try and position what's the fundamental backdrop on top of the tactical backdrop. And it was very good to see a drop in yields. And so many are focused on whether the Fed is, you know, just when they're done or not. And you hearken back to banks and small caps, and home builders had the best week since April of 2020. Remember what was going on in April in 2020? The Fed had announced that they were going to buy high yield debt. We're just trying to figure out if they're done yet. I think they're 100 basis points overdone, and it's a foregone conclusion, which means ultimately, after we get this relief rally, which we're in the midst of, I think bad news has to be priced as bad news if you go into that recession environment.
Tony, recency bias was a phrase that was thrown at me a few times already this morning, just extrapolating out last week's price action. Feels like we're doing that from week to week, week to week. Let's just sit on the bond market for a while. 2 weeks ago, we had yields through 5% on a 10-year yield, cycle highs. This morning, we've got a 10-year back to about 460, break of that level in the last couple of sessions. Tony, is there reason to believe that the highs of a few weeks ago were the highs?
Yeah, I think it's likely that they could be the high. Whether it is or not, and you go back and test, it doesn't matter. Let's put it in perspective to everybody watching. What typically kickstarts economic activity? Why does the market make a low in a recession? Because there's an improved outlook for money. Rates come down far enough that you can kickstart a refi cycle. 82% of mortgages, 30-year conventional mortgages, are below 5%. Buddy, that's almost 300 basis points below today. So the point that you had a 60 basis point or a 40 basis point, that is fantastic. And that was the catalyst for the oversold rally to really kickstart a fundamental improvement in the mortgage market that allows for an improved outlook for money over the longer term. You need a dramatic drop. And the tone that the Fed had coming out of, you know, the 2020 debacle, where stocks acted in a kind of similar way, was very different than it is today.
Well, let's talk about the tone of the Fed last week, more recently. The pushback that we're expecting this week, Barclays specifically. This is what the team over at Evercore have to say as well. You've got Barclays looking for one more hike, but in January 2024, they're pushing it out. They see this as very, very circular. Evercore said this morning. We expect Fed speakers this week will try to lean against any continuation of the rapid retreat in yields and easing of financial conditions late last week, triggered by the Treasury funding announcement, the November FOMC meeting, and labor market data that ease fears of overheating. Over at Barclays, this similar view that maybe this has become quite circular and perhaps this Federal Reserve has to push back to what we heard and what we saw in response to what we heard, Stuart, last week. What's your thoughts on that, Stuart? The Federal Reserve almost endorsing tighter financial conditions, doing some of the work for them, and then unwinding those tighter financial conditions in the space of a few trading days.
Look, I think this is the downside to trying to target market-based financial conditions, right? You end up chasing your tail a little bit, and it's very hard to kind of thread the needle on communication. So, you know, communication is a policy tool for them, and it's sometimes effective. And I think when it is effective, sometimes it can overshoot, and they ultimately have to then go back the other way. So, look, I think when you have a Fed that doesn't have as much confidence in its forecasting ability as it used to, and a market that's a little skeptical of their forecasting as well, you're basically chasing the market, and you're going to get a lot of ups and downs. And to your point, week to week, it's a different story.
It's a different story last week compared to the week before. Is it going to be a different story this week? Mike McKee, we've got data, we've got Fed speak, and I believe we've got some Treasury supply as well through the week.
Probably not going to have a different story, though, John. The plot changes a little bit, the characters change a little bit, but the novel remains the same. Let's look at what's happened. You guys have been talking about it this morning. This is the last month for the 10-year note yield. Remember, we got to that high, and everybody said the world was coming to an end because the Fed was now going to have to respond to the market, and then we had the supply last week, followed by the Fed doing nothing, and then the jobs report, and now, of course, the world's coming to an end again. What's going to change that? I don't know. We do have a lot of supply. You mentioned that. Someone has to buy $330 billion worth of treasuries this week and $40 billion approximately in corporates. We'll see what the price is. I mean, it'll all get absorbed, but what is the cost and how high will interest rates have to go? Maybe that does make somebody think a little differently. Fed calendar, very, very busy. We've got 11 Fed speakers, 17 speeches, and almost none of it is going to matter because the Fed doesn't meet for another 6 weeks. So what they say this week doesn't matter all that much. A couple of interesting ones, though. Jeffrey Schmidt, the new Kansas City Fed president, makes his first speech. Jay Powell on Thursday, everybody's going to listen to. And then Ms. Pease, the acting president of the St. Louis Fed, is giving a monetary policy speech. That's very, very unusual for an acting president. They're still looking for someone to replace Jim Bullard. So it'll be interesting to see what she has to say. But since she's speaking right before Jay Powell, I don't think it's going to have a lot of market impact, which gets us back to my theme. The week's not going to change a whole lot because we're 6 weeks out from the Fed. The market replaces John minute by minute, and the Fed does every 6 weeks.
And Mike, you know the game we'll play in between, don't you? We'll do this for the next 6 weeks, no doubt about it. Mike McKee, thank you. The line from Barclays: the dovish turn may have backfired. Tony Dwyer, has the dovish turn backfired already, given the moves we've seen in equities, in bonds, in credit?
John, the insanity of what we're doing, to your point earlier, is chasing our tail every time there's a market movement. How many times over the last 2 years have we heard the market's breaking out, and anytime it's done this, it's been a new bull market, only to find out it's breaking down, and anytime we've done that, it's a new bear market. And those typically are the extremes. I just believe that the economic data doesn't turn that quickly. Now, the problem that the Fed has that very few people know about is it's called the survey initiation rate. It's how many companies and individuals respond quickly to the survey from the government that they use for the data. And post-pandemic, it has been extraordinarily low. That is why we're getting the kind of revisions in the labor data that we get. I mean, think about the fact that the government gets our data on income spending and the unemployment rate in the household survey done by the Census Bureau. They still survey us by knocking on our door and calling our landline. John, do you have a landline?
I don't have a landline, Tony. I'm not sure the last time I had a landline. Tony, I'm with you.
I mean, the point is, I trust the trend of the data, not the data. And anytime that you've had this kind of a rise in the unemployment rate from the cycle peak, it's a heads up that we're weakening. And almost all the bullish scenario, and by the way, I'm closer to being bullish than bearish because we're close to bad news being priced as bad news.
Sure.
But it's all based on a strong consumer based on high employment. What if that changes and has already changed?
Tony, I'm with you. The price action writes narratives. It's always the way. And when you see big moves like what we saw last week, people are going to ask, has something changed? So let's go through the moves. 6% move, there and thereabouts on the S&P 500. 6.5 on the NASDAQ 100. Big move lower in bond yields, 2-year, 10-year, 30-year, right the way through the curve. Stuart, we need to go back to where we started this conversation. Stuart, did something change last week? Let's put the price action to one side. Did we learn something new? And Stuart, for what I get from you, you think we did?
I mean, I don't think you learned anything completely new. I think you got, some things that were uncertainties kind of crystallized a little bit. I mean, last week was very much a risk-on, low-quality rally. Our short interest stocks were up 18% week on week. So you definitely had folks that were kind of forced back in to cover some stuff that they had been short. That suggests that they were surprised either by the incoming data or by the tone of the Fed. And that's kind of what drove markets last week. This week, we think it'll calm down a little bit. Typically, those positioning type moves tend to burn themselves out relatively quickly. And I think, to Mike's point before, I mean, you have a little bit of a dearth of data this week. So it's going to be a real test of, do you need macro data to push the market higher? Or in kind of a data vacuum, will positioning momentum, kind of continue to rule out? Early this morning, it seems like momentum will work, and that's what we expect. But it's going to be a big test for the markets with not much data this week other than claims and some Treasury auctions.
And Stuart, I'll throw in another one as well. a lower bond yield sufficient for a rally regardless of why bond yields are lower? Now, Stuart, the reason I bring that up, as you know, because you've said all year basically that this is a rally built on good economic data. And good news is good news and bad news is not going to be good for this market. Stuart, can you tell me, is that still the case from your perspective?
Yeah, it definitely is still the case. And I think one thing to respect, too, on the positioning side, as much as people might have been short equities, they were short bonds as well, right? So you have this move in yields, and you also forced people, particularly systematic buyers, back into the bond market. So that can kind of, create a little bit of an overshoot on yields. But look, from my perspective, yeah, good news is still good news. If you took out the strike impact, you printed 185,000 jobs last week, following up on almost 300,000 on a revised basis, the previous month. So in our view, some of the forward-leaning indicators like credit card spending look a little weak, but, the reported economic data from the government, still looks solid. And until that's not the case, yeah, we do think good news is good news and the market can move higher.
We'll continue this conversation. Stuart Kaiser, Tony Dwyer are going to stick with us. Some different views there, some nuanced views on where we're going next in this market. We still need to talk about this massive run we've seen for the bank stocks. Last week, KBW Bank Index up 11%. We'll get to that conversation in a moment. Futures right now positive 0.2% with some movers going into the open. Here's Abby.
John, well, we have had some breaking news over the last 10 minutes or so. Let's take a look at the shares of PepsiCo and Disney. PepsiCo, that stock is down about 1%. Their long-term CFO, Hugh Johnston, is leaving the company for Disney after 34 years, 13 years as CFO. He'll be leaving on November 30th, starting at Disney on December 4th, and he will be receiving a one-time $3 million signing bonus. James Caulfield at PepsiCo has been named as the new CFO at PepsiCo. Berkshire Hathaway up about 0.7%. They put up $93.2 billion in revenue in their last quarter. That was a roughly 5% beat. Their cash pile grows, John. It is now a record $157 billion. Some might say that the recent selling in stocks, well, it hasn't been bad enough or fearful enough for Berkshire Hathaway to be greedy enough to start buying.
Abby, thank you. More on that around the opening bell. Coming up on this program, bank stocks recording their best week since 2020.
The banks can also rally into year-end if we have this pause in yields and still constructive sentiment.
The financials looking for a 6th consecutive day of gains. That conversation up next.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behaviour was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
concern about the banking sector is that I do think 2024 is going to be a harder year from the perspective of the economy, and especially from the perspective of charge-offs, delinquencies, bankruptcies, and defaults. And if you think about what one sector is most likely to feel all of that, whether it's the defaults in commercial real estate, whether it's bankruptcy filings, whether it's consumers defaulting on perhaps their credit cards, I think it goes all right back to the banking sector.
US bank stocks recording their biggest weekly advance since 2020, rebounding from their lowest level in 3 years on growing hopes that the Fed is done raising interest rates. Analysts at KBW upgrading Bank of America this morning, citing the recent decline in long-term rates following the better-than-expected productivity report and weaker-than-expected jobs report. Shani Basak has more. Hey, Shani.
Good morning, John. You're looking at the regional banks starting to also bounce back on the heels of not just this idea that you have the yields overall starting to cool to a bit. You also have this idea of the yield curve facing a lot less pressure than it had been earlier this year. So, for example, even in the 230s curves, you've seen moments of disinversion earlier this month as you look to the picture for the banks getting a little better. Now, some of the worst badly beaten of banks here are still down quite significantly. Take First Horizon Corp, still down more than 50%. KeyCorp is still down more than 34%. KeyCorp is one of those banks that Bill Gross has recently said he's bought into, along with Citizens Financial, Truist, KeyCorp, some of the bigger of the regional banks here. I've got to say, when I talk to my sources across Wall Street, it's not just the stocks that they're looking to buy at a bottom here, because remember, we did see a bigger sell-off in the KBW than we did even in March in terms of retesting new lows. In the last week, we have hopped 11% higher on that KBW Bank Index. We're still off by 30% from the highs of this year, and the worst of the worst banks are significantly beaten down further than this. People are starting to buy not just the stocks, but also the bonds. For example, that KeyCorp story that I was telling you about, you had them trading at less than 90 cents on the dollar, certain bonds of KeyCorp, now back up to 93 cents. So the picture is looking like it's starting to improve. That is contingent on the credit quality of these banks in terms of their loan books also staying healthy throughout the remainder of next year.
Shanali, thank you. Just a massive week of gains for the financials on the S&P 500, the bank specifically last week. Back with us for a final word, Stuart Kaiser, Tony Dwyer. Stuart, you put out the note over the weekend, upside ideas for a data vacuum. Are the financials one of those upside ideas?
The financials are not one of those upside ideas, Jonathan. Unfortunately, I wish we had gotten that right last week. But look, I think for the financials, you need to split the regionals out from the large caps. But if you look at large cap earnings, they did highlight held to maturity losses and higher deposit costs, which have obviously a negative read through down to the regional side. You also have a deal calendar which hasn't been, kind of as robust as you would like, and you have the threat of large capital requirements. So, the banks kind of don't fall into that category. From our perspective, you want to be trading, kind of upside into year-ended equities, via tech and momentum. So that'd be Q's upside is probably the default, or maybe some call options in the bond market as well. But we've got a long list if you want all of them.
Give me all of them, Stuart. Give me three.
Give you three. Look, we like owning Q's upside, so 390 strikes on triple Qs. We like owning 90-95 call spreads on TLT, for a view that, if CTAs have to come in and buy bonds, you can get overshooting yields. And if you fully disagree with us, which means you're probably in the majority, then, I think you attack that through cyclicals. And that's just simple. I think you just go for IWM from that perspective. Russell 2000 is still net down year to date. So if you think you're going to get this sort of lower quality rally continuing into year end, that's the poster child for stuff that's lagged.
Let's get to the second piece, the bond call. Within that, what it means for the equity market. Tony, last week what we saw was lower yields benefit financials. Do banks need lower bond yields from here to perform into year end?
I don't think it was just the lower bond yields benefited the entire market, and anything that had been hit on higher bond yields. John, you can say the same thing about home builders, utilities, real estate. All of them had outsized rallies because they were down so much. I mean, banks, the KBW Bank Stock Index was down 51% going into the beginning of last week. How much do you think they're supposed to go down? So I think at this point, a lot of the negative influences are probably discounted, even in a recessionary environment, which means you're probably going to get some chop around lows. Lows or bottoms are made on time, not price. You can have a trading rally along the way. I looked, before I came on the show, I looked to see when the BKX had, which is KBW Bank Stock Index, has had a 10% or more than a 10% 10-day rate of change. In other words, over 2 weeks, they've gone up more than 10%. It's taken place 4 prior times this cycle by my eyeball. I didn't, map it out on Excel, which means that if you just made it low, those prior 4 times weren't the right buy. I think we're getting closer, but you really need to have those recessionary indicators come in so that the outlook for money can improve more than just the Fed may not raise rates again.
Tony, just to finish up, I get the sense from you that you just want to sit this out for a while and wait to see that deterioration come to the surface before you actually get involved in buying risk in any material way.
Well, we did last week for a little bit. The stage was set for a rally. But yeah, we've been light and tight, John, for the better part of 2 years. And as you know, I'm kind of known as the perma bull, unless the outlook for money remains poor. And I think that is the case. Cash has outperformed over the last 2 years. There's no need, in our view, to take a major bet. I don't like to guess with my money. I certainly don't like to guess with the viewers' money. And right now, nobody has any idea what the bond market's going to do. So we're in this sit and wait and be convinced, because that's what leads to conviction and the ability to really chase a rally or buy into a meaningful dip.
I have a great deal of respect for you both. You know that. Tony Dwyer, Stuart Kaiser, thank you, gents. Appreciate it as always. Going into the opening bell, coming up the morning calls and later. State Street's Laurie Heinel making a case for safety. That conversation still around the corner, about 7 minutes away. Your opening bell up shortly.
This will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point, what is the lesson or the observation?
Five-day winning streak on the S&P 500. Longest daily winning streak going back to June. Can we make it day 6? Futures just a little bit higher. That's the price action. Let's get you some morning calls. First up, KBW upgrading Bank of America to market perform, pointing to an attractive valuation and the recent decline in longer-term rates. Bank of America downgrading Paramount to underperform from a buy, cutting shares by 2 notches with limited asset sales on the horizon. And finally, Barclays upgrading Clorox to neutral, seeing a favorable setup for a meaningful earnings recovery. That stock is positive by around about 0.75% in early trading. Coming up, State Street's Laurie Heinel expecting geopolitical tensions to fuel a volatile year ahead for the equity market. That conversation up next. Your opening bell just around the corner.
the younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Authorities
could face bigger challenges next.
It was going to keep Green World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Five seconds away from the open and bow this morning. Good morning. Coming off the back of the biggest week of gains of the year so far on the S&P 500. 5-day winning streak, looking to make it day 6. Your equity market positive here by 0.1% on the S&P. On the Nasdaq, up by 0.1% after a massive week of gains of more than 6% on the Nasdaq 100. There's your open and bow. Switch to the board and get to the bond market. Yields look like this. Last week, aggressively lower. This morning, higher by 5 basis points. Your 10-year, 4.62.44. Last week lower on a 10-year by more than 26 basis points. On a 2-year lower by around 16 this morning. Your 2-year a break of 4.90. In the FX market, tons of dollar weakness last week. The euro against the dollar, that currency pair, the best week of gains going back to July. This morning we add a little bit of weight to that rally. The euro back to about 107.42. And in the commodity market, 82 handle on crude, up by 1.9% on the session. 30 seconds into this session, the start of a brand new trading week. Your equity market positive by 0.25% on the S&P. On the Nasdaq, up by 1/3%. 2 names to watch at the open. PepsiCo's one, Disney the other. PepsiCo CFO Hugh Johnston leaving the company to become the CFO of Disney. Johnston writing this: "I'm grateful to everyone who I have worked with and for the trust which has been placed in me. PepsiCo will always be a very special place." Abby has more. Hey, Abby.
Hey, John. Well, that makes a lot of sense. He was there for 34 years as CFO for 13 years, so a real history with PepsiCo. And you, of course, have interviewed him a number of times. Great executive for sure. So lots of C-suite changes. So he is leaving PepsiCo for Disney. This change will happen. He'll be leaving PepsiCo on November 30th, starting at Disney on December 4th as their CFO. He will receive a one-time signing bonus. James Caulfield has been named as the new CFO at PepsiCo. The stock's not really reacting all that much. Where we are seeing more of a reaction, though, is another stock where there's been a C-suite change announced, and that is Bumble. Whitney Wolfe Herd will be stepping down from the company she founded nearly 10 years ago. The stock is paced heading toward its worst day since March of this year. Slack CEO Lydia Ann Jones will take over starting in January. Evercore ISI analysts are saying that they're incrementally negative on the news. They need to learn more. Well, the stock, John, it is down 80% or so from its IPO. So lots of work there to be done.
Abby, thank you. Lots of changes in the C-suite this morning. We'll talk about Dish with Simone Foxman a little bit later. We'll catch up with her in about 5 minutes' time. Let's turn to the auto space. Shares of Tesla moving higher for a 5th consecutive session, getting a boost from a Reuters report saying the company will manufacture a new €25,000 vehicle at its factory near Berlin. Katie Greifeld on top of this story. Hey, Katie.
Hey, John. Yeah, Tesla up about 2% on the moment on the heels of that report from Reuters that it will produce a €25,000 EV at its factory near Berlin. Now, for context, its current least expensive sedan retails for just under €43,000 in Germany. So this would be a dramatic step down in price. Now, according to Reuters, CEO Elon Musk, he announced this plan to staff last week while visiting the factory. He didn't specify when production would actually start. And keep in mind, this is something that he's been teasing since at least 2018. But competition for affordable EU-made EVs is building. You take a look at Stellantis. They're taking reservations for a 23,300 euro model, while Volkswagen is planning its own sub 25,000 euro model as well. Now Tesla reportedly throwing their hat in the ring. That's giving a slight boost to shares, on track for what would be a fifth day of gains, John.
Fifth day of gains there, Katie. Thank you for Tesla. Sixth day of gains on the S&P 500 this morning. Just inching higher on the S&P about 3 minutes into the session by 0.2%. Elsewhere, Berkshire Hathaway reporting results over the weekend. The company's cash pile hitting a record $157 billion as a result of fewer deals and higher interest rates. The company writing this: the amount of investment gains and losses in any given quarter is usually meaningless. That can be extremely misleading to investors. Shanali Basak has more. Hey, Shanali.
Hi, John. When you're looking at those investment losses, certainly they're stunning when you look at Berkshire's portfolio. Yes, they waver. But let's look at just Berkshire's biggest bets. And you are seeing the market reaction to Berkshire Hathaway now. You are seeing nearly, for the first 9 months of the year, $1 billion, nearly $1 billion worth of investment losses on Berkshire's portfolio. And you look at some of their biggest bets: Apple, even American Express, which was up in the quarter, but muted in terms of gains from the prior quarter. Bank of America, the biggest stunner of them all in terms of how poorly they've performed this year, all facing a lot of pressure this year and therefore also weighing on Berkshire's portfolio. Now, that $157 billion in cash on Berkshire's portfolio helps them in some ways because, of course, cash means more today than it did a year ago. And if you look at their insurance segments here, you're also seeing them raking in investment income on the back of higher yields. But the yields, of course, are not quite compensating enough for the market, as you're seeing in terms of the pains they're seeing in their investment portfolio. Even some of the operating segments, which are up quite meaningfully, we'll point to one in particular here, which is BNSF, which saw profit fall because of the weight of inflation and lower volumes. And so, of course, big economically sensitive stock. This is a bellwether to the American economy in some ways. Those types of signs are where you see a little concern.
Shanali, thanks for the update. Berkshire Hathaway there, just a little bit negative, down by 0.1%. Back to some more changes in the C-suite. Dish announcing its CEO is stepping down. The company writing in a statement, Erik Carlson intends to resign on November 12th. He will remain on the board of directors through the closing of the merger between Dish and EchoStar. Simone Foxman has this. Hey, Simone.
Hey, John. Yeah, this really seems to be relating to that pre-announced merger. Hamid Akhavan, the CEO of EchoStar, will become president and CEO as Carlson steps down. I think what analysts, though, are reacting to this morning and why we're seeing shares now down over 15% are some of the really terrible numbers that we got from Dish in their earnings announcement. Analysts were actually expecting a profit of 6 cents a share in the third quarter. Instead, they got a loss of 26 cents a share. Third quarter revenue missing estimates down about 10% year on year, and the company lost more subscribers than they expected across pay TV and wireless, losing, in fact, 225,000 mobile users. That's more than 4 times the loss that analysts had anticipated. The company also announcing that it was selling some spectrum assets and about 120,000 prepaid subscribers in Puerto Rico and the U.S. Virgin Islands. Dish says it's going to use the money, $256 million, to boost its capital for the U.S. business. But Citi says this wireless performance is really a concern for the broader 5G wireless strategy. And analysts there believe the post-merger company will still likely need to raise external help beyond 2024 to meet upcoming funding needs and maturities. They're looking for more information at the call at noon in New York time. We're already trading around 1998 levels and shares down over 16% now today, down 67% year to date, John.
Simone, thank you. That name this morning getting absolutely hammered. In the last week, this equity market moving in the other direction. We're about 6 minutes into the session. 6th day of gains on the S&P 500, positive here by 0.2%, adding a little bit more weight to the rally we saw last week. Again on the S&P, biggest weekly gain of the year so far, a gain of 5.85%. Last week, yields lower. This morning, yields a little bit higher. Look out for the supply on both the credit side and the Treasury side through the week and a week ahead. The 2-year right now up 6 basis points to about 490. 10-year maturity up 5 to about 462. Bear in mind where we were 2 Mondays ago. 2 weeks ago, we had a yield through 5% on a 10-year, aggressively lower over the last week. Here's the slate of supply to look out for. Mike McKee mentioned it a little bit earlier. Just bringing up the numbers on the Bloomberg. $48 billion of 3-year notes coming up a little bit later this week. Then it's on to 40 billion of 10-year notes and 24 billion in 30-year bonds. That's a lot of supply following a big week of gains for the Treasury market, rallying, yields lower. Let's see what that kind of action provided by those bond market supply that we get later this week. It's going to be amazing to see. State Street's Laurie Heinel discussing her outlook for the year ahead, writing this. Our highest conviction idea for 2024 is long duration US rates. We continue to hold elevated levels of cash, but we'll soon to deploy that cash opportunistically. I'll get my words out, Laurie. Forgive me, I've lost my voice over the last week. Laurie, let's start there. We've got $5 trillion plus of cash sitting in money market funds in America. Laurie, what's going to unlock that cash?
Well, first of all, what's going to unlock that cash is certainty that the Fed is more or less done. And we've gotten some early signs that perhaps the rate hiking cycle has ended and the next move will be lower. So being confident that rates are not going to go much higher, that they're actually going to go lower. But the other thing is going to be that we're actually navigating a soft landing, because there, again, for investors to get a bit more willing to put some trades on and actually take on some risk, they have to be more confident that this soft landing has actually been engineered.
Laurie, do you think we've got that stability in that bond market, given the moves we've seen? Last week, I get it, yields were lower, but can you make the call that the bonds are stable with moves like the ones we saw last week?
Well, volatility is going to be the key throughout most of 24 in our view. But we do think that at these yield levels, long duration treasuries still look pretty attractive. Certainly the move has taken a little bit of that opportunity away from us, but we think that going into 2024, if U.S. sees a growth rate of somewhere around 2% or so, it's likely that bond yields will continue to come down. So our highest conviction trade for those who are looking for more opportunistic investments is to go long duration treasuries.
What does that mean for the equity market call, Laurie, as you take on more duration and fixed income? Where does it leave stocks?
Well, we think stocks do okay in 2024, but it's going to be a bit of a transition year because, again, it's hard to envisage that the earnings will keep pace with where a lot of the forecasts are right now. There still will be, we think, some pressures in terms of growth sort of abating. We think that there will be still some inflationary pressures that will flow through, and some of the wage gains will start to flow through. So we think equities do okay in 2024, but we think the big move is going to be in bonds.
Is there a slice of the equity market that you prefer, Laurie, that you'd advocate for over something else?
Yeah, well, we're looking for those places where there's, pretty good risk reward. So we still like quality balance sheets, so companies that don't have to refinance in 24, 25, 26. We still like those companies that are a little bit more geared to those tailwinds, so companies that will benefit from the Inflation Reduction Act and the CHIPS Act, and those places that are much more durable, think consumer staples.
Where do the banks fit into this, Laurie? We touched on this with Stuart Kaiser and Tony Dwyer a little bit early this morning. We've just had a massive week of gains for financials. KBW Bank Index up by something like 11%. That weekly gain off the back of the bond market rally we saw last week as well. Do we need bonds to rally for bank stocks to outperform?
We don't necessarily need bonds to rally for bank stocks to outperform, but we need a little bit more certainty that we're not going to have a recession, right? So, banks do well when there's still expansion, when there's credit demand. So a little bit of that would be healthy for banks. Valuations are pretty attractive, and as we continue to get kind of past these concerns about capital, we think banks could do better from here.
Laurie, thanks for the update. As always, Laurie Heinel there at State Street on this equity market. Gains this morning, about 11 minutes into the session, up by 0.2%. Coming up, the U.S. continuing diplomatic efforts in the Middle East.
We're working, as I said, very aggressively on getting more humanitarian assistance into Gaza, and we have very concrete ways of doing that. And I think you'll see in the days ahead that assistance can expand in significant ways.
That conversation up next.
I know one of the reasons you're here in Marrakesh and in Africa, because you see the enormous potential this continent has as a source of renewable power for electrolysis, right? That's the process by which hydrogen is extracted from water. Tell us about Africa's potential.
Africa's potential is the best in the world, and it's Africa's shot now. It's Africa's turn. What will stop Africa rightfully taking its turn will be lack of progress on technology. Companies and governments around the world choose Fortescue because we are the world leaders in technology, world leaders in next era electrolyzer design, cables, solar, all the tech which is moving our world on from having to rely on dinosaur era fossil deposits of oil, coal, and gas to simply today's era of machines which make machines to harness all that beautiful renewable energy and give all the mobile energy, all the fixed energy this world could ever need by many times. Those countries who resist that are denying Africa their opportunity. And I'm saying, stop it. Let's get in behind Africa.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
One of the common denominators that I've heard throughout this trip is the imperative of American engagement, American leadership. Every country I talk to is looking for us to play a leading role with our diplomacy to try to make progress on all of these different aspects of the crisis. We're working, as I said, very aggressively on getting more humanitarian assistance into Gaza, and we have very concrete ways of doing that. And I think you'll see in the days ahead that assistance can expand in significant ways.
Secretary of State Antony Blinken arriving in Turkey after unexpected visits to the West Bank and Iraq. Diplomacy efforts continuing with stops in Japan, South Korea and India as the administration looks to refocus some of the attention on China. This is Secretary Yellen and her Chinese counterpart prepare for 2 days of talks on Thursday, with Biden and Xi meeting days later in San Francisco. Anne-Marie joins us now for more. Morning, Anne-Marie.
Good morning, John. Well, foreign policy is absolutely dominating the Biden administration. Over the weekend, we saw more frenetic diplomacy with Secretary of State Antony Blinken in the region, in Israel and in other Gulf states, making the surprise stop as well, speaking with Mahmoud Abbas in the West Bank, in Iraq and in Turkey. On top of that, Jonathan, Bill Burns, the head of the CIA, is also in Israel today and is going to be traveling throughout the region. So clearly what you see from this administration is, one, they want to make sure humanitarian aid is getting into Gaza, and at the same time, they also want to make sure that this conflict is not spread throughout the region. And when it comes to foreign policy, and you're talking about this sit-down between President Biden and Xi Jinping, well, China and the United States have taken the opposite ends of these conflicts, whether it be Israel and Hamas, which Hamas is backed by Iran, or Russia and Ukraine. So this will be top of mind. But when it comes to Secretary Yellen, she's going to be sitting down with her counterpart, Jonathan, and for her, it's all about the economy. Writing an opinion piece this morning in the Washington Post, listen to what she had to say. This week, I will speak to my counterpart about our serious concerns with Beijing's unfair economic practices, including its large-scale use of non-market tools, its barriers to market access, and its coercive actions against U.S. firms in China, Jonathan.
Anne-Marie, let's put two stories together. There were some big protests over the weekend in the nation's capital. I want you to try and put that together with one poll we saw from New York Times, Siena College, with the former President Donald Trump leading in 5 critical swing states against the current President, Joe Biden. What's the pressure like within his party to take a different path?
Well, the pressure is palpable, Jonathan. When I walked into the White House this morning, what you see outside the White House concrete is handprints of blood. And what they are calling for, these protesters, is a ceasefire immediately in Gaza. Now, there are some protesters, Jonathan, who are calling for a ceasefire because they want to stop the bloodshed. They don't want to see, no one wants to see innocent civilian lives in the Palestinian territory of Gaza lost. At the same time, though, Jonathan, this administration wants to make sure that they are supporting Israel as they defend themselves from Hamas after that horrific massacre on October 7th. What you're seeing in these polls, Jonathan, though, is in these swing states, like the New York Times Siena poll, similar to Bloomberg's News' poll with Morning Consult, the former president is winning when it comes to things like national security and the economy.
Kelly Lyons is going to join us right now to talk about this. AMH, thank you, down in Washington. Kelly, let's cross over to you. We've got another debate for GOP candidates a little bit later this week. The Republican Party is going to take the focus on that front. Do we have to start thinking about a different candidate for the Democratic Party as well?
Well, there are some who are calling for that now on the Democratic side in light of the poll that you and Anne-Marie were just discussing. In 5 of these states, it is Trump that is leading Biden, and Biden is really struggling with key groups of voters, Hispanics, blacks, and voters under 30, not seeing the same support he did in 2020. And that's definitely a very troubling sign in the Democratic camp, assuming that it is former President Donald Trump who would be the nominee competing with Biden in the general election. We still have a ways to go to actually get to that point, though. There is still a primary race that is happening. And to your point, John, those primary candidates, Donald Trump aside, he will once again be counter-programming the third primary debate in Florida, will be on the stage in Miami. Nikki Haley, Vivek Ramaswamy, Chris Christie, Senator Tim Scott, and Governor Ron DeSantis. You can expect that the conflict between Israel and Hamas will feature quite heavily in this debate, and Nikki Haley, whose campaign has built a great deal of momentum over the course of the last several weeks, is likely to flex her foreign policy experience, given she is a former ambassador to the UN, not just the former governor of South Carolina. But Ron DeSantis is going to go into this with a little bit of momentum as his own, According to Bloomberg's reporting tonight, the governor of Iowa, Kim Reynolds, is set to endorse Ron DeSantis in a critical state. Of course, this is where the caucuses will begin just about 2 months from now on January 15th. And it's a state in which Ron DeSantis has really been struggling. He's seen his polls slipping pretty much everywhere, but in Iowa specifically, he has a 27-point gap to close between him and former President Trump, who remains the frontrunner. And also importantly in Iowa, a poll last week showed he is actually tied with Nikki Haley in that state at 16%. So we'll see if this pretty key endorsement is able to give him a little bit of a boost that his campaign, frankly, desperately needs.
And Nikki Haley with some real momentum over the last couple of weeks. Kelly, thank you for the update. About 20 minutes into the session, positive here by 0.1% on the S&P 500. Bit of calm after a monster week of gains on the S&P last week of close to 6%. On the Nasdaq, higher by more than 6% last week on the Nasdaq 100. This morning, the Nasdaq higher by, let's call it, 1/4%. In the bond market, mentioned this a few times already this morning, look out for the supply from the Treasury and also on the credit side throughout this week. Yields are higher on a 10-year by 6 basis points, 463. On a 2-year higher by 6 basis points, just short of 490. Further out down the back end of the curve on a 30-year yield higher by 4 basis points at 481. Let's get you some sector price action. Here's Abby.
Well, John, consistent with a very small gain for the S&P 500, not so much happening beneath the lid for sectors, but let's break it down because we do have a couple of sectors that are interesting. Real estate is the worst sector on the day, down 1%. This having to do with the fact that yields are higher, those dividends look less attractive. Industrials, materials, financials, energy also down. Then to the upside, it's an unusual mix. Tech up the most, up 0.5%. Then you have consumer discretionary, followed by the defensive sectors of utilities and healthcare. Let's take a look at that big bank rally that you have been talking about a few times this week. It really is pretty extraordinary over the last 6 days, and today we're actually down a little bit. But even so, over the last 6 days, there we have that the KBW Bank Index, and also if we were to take a look at the KRE, the regional banking ETF, up about 10% to 11%. The best stretch going back to June or July of this year, John.
Tech outperforming this morning. Abby there with an update on the banks just at the end after a stellar week of gains on a KBW Bank Index. Coming up on this program, the trading events you need to be watching, your trading diary. Coming up next.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Like, please, like, really actually tune in. I desperately need an audience.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Today, my outlook is that we're going to stay on that slow and steady. And if we continue to do that, then I think where we are now will be sufficiently restrictive to get us to the 2% level for inflation. But there's still a lot that's going to happen between now and even the next meeting.
Atlanta Fed President Raphael Bostic catching up with the brilliant Mike McKee at the end of last week. This Federal Reserve, in the eyes of many, sounds like it's done. Deutsche Bank, Brett Ryan, thinks this Fed is done. Rick Reeder on this program last Friday, BlackRock thinks this Fed is done. Citi, Andrew Honhorst also thinks this Fed might be done. Barclays out with a note earlier on this morning. This is getting some buzz that maybe this Fed is not done. That maybe they have to push back against some of the easing of financial conditions we've seen over the last week or so, and perhaps this Fed's going to start hiking again in early 2024. That's the call from Barclays this morning. If you are just tuning in this morning, good morning to you. About 25 minutes into the session, equities shaping up as follows on the S&P 500, higher for a 6th consecutive day, the longest winning streak on a daily basis going back to June of this year, following the biggest weekly gain on the S&P 500 of the year so far, adding just a little bit more weight to the S&P and the Nasdaq 100. That's the equity story. Here's the bond market price action, 2-year, 10-year, 30-year. Last week, the 10-year yield lower by more than 26 basis points. This morning, higher by 6 basis points. We're higher across the curve, 2s all the way out to 30s this morning. 2-year also higher by 6 basis points, reclaiming 490 on a 30-year, back to about 481. We've talked about this a few times already this morning. Look out for it all through the week. Issuance, supply from Treasury, 3-year, 10-year, 30-year, all worth a little look through the week. That's the price action. Let's get you a sneak peek at a trading diary. Coming up through the week, Fed Governor Lisa Kirk speaking at 11 a.m. Eastern Time. Tuesday, more Fed speak. Schmidt, Waller, Williams, Logan, and Barr. Plus the U.S. kicking off Treasury issuance with a 3-year, $48 billion worth of issuance coming up on a 3-year maturity later this week. Wednesday, Disney reporting after the closing bell. More Fed speak with Cook, Barr, Jefferson, and Chairman Powell, the headline of the week. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behaviour was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong? Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Yeah. Matt Miller here. I'm in with Emily Grafeo for the hour. Pretty pumped up about that. She's a Bloomberg cross-asset reporter, and she's going to join me because Paul has stepped out for a long lunch. I'm really pumped about this new Bloomberg Apple CarPlay functionality. And I'm sitting with three people who, don't drive, or John Tucker, who just, drives all the time.
But I don't listen to the radio.
You don't listen to the radio? Except for when it's Bloomberg radio.
Oh, yeah, no, that's it, yeah.
Do you not listen to the radio?
I don't like to be distracted.
Oh, my goodness. All right, in any case, so Bloomberg has now been integrated into Apple CarPlay, or into whatever the Android version is called, Android Auto, I think. So basically, when you have the Bloomberg app on your phone, and then you connect it to any modern vehicle, you'll be able to see a dashboard of apps in your car. And Bloomberg is now one of those apps. That's why I'm so pumped. Does anyone else? No. Okay.
Oh, yeah, no, we're pumped.
When you guys, John Tucker, when you get to this century and when the rest of you get cars, you'll understand. Let's get over to JT right now. He's got your Bloomberg Business Flash for you.
All right, Matt, stocks slightly higher in the early going. Risk sentiment getting a lift by bets that the Fed's going to cut interest rates as soon as next year. This was bolstered by the data we got Friday on the softening labor market, perceived by some as, yes, forgive me for saying it, a Goldilocks scenario. But not everybody agrees. Economist Dennis Gartman pushes back against the idea the Fed's going to be cutting in mid-2024.
It's going to be a long time before the Fed begins the process of easing monetary policy and letting the overnight Fed funds rate decline again. It's going to be at least until late in 2024, maybe early 2025 before we see less than 5% on the overnight Fed funds rate.
Right now, the S&P 500 up 5 points. That's up 0.1%, 4363. Dow Jones Industrial Average dead flat, 34,060 on that index. The S&P, the NASDAQ 100 right now up 33 points. That's a rise of 0.2%. Lots of moves in the C-suite. Hugh Johnston leaving his post as CFO of PepsiCo. He's going to join Disney. And the Bumple's CEO Whitney Wolfe Herd stepping down from the company she founded 10 years ago. As we look at rates right now, the Treasuries, the 10-year yield, that is up 7 basis points, 464. The 2-year, 6 basis points higher. That's at 489 right now. There's new research that shows using cannabis products every day raises many of the same risks of severe heart disease that affect frequent cigarette smokers. These are findings that will be presented at a meeting of the American Heart Association taking place in Philadelphia.
Not sure about that. You know what? This is the thing. I looked at the story, and it doesn't say how those people were using cannabis. So, were they eating gummies? Or was it some kind of tincture? Were they smoking big fat blunts?
Daily use of the drug linked, and I say drug, was linked to a 34% increased risk of developing heart failure. The study followed more than 150,000 Americans for almost 4 years. So I would say the data being presented in Philadelphia is good. It's solid.
What? I don't know. I need more details on that before I can make a decision that would change my daily habits. In any case, thanks very much for that, John Tucker. Let's get over to Bailey Lipschultz right now. He's in the studio and not at risk, as far as I can tell, of increased heart disease. Bailey, what do you see in these markets?
I am not, and I will say, Matt, color me shocked to hear that if you smoke things, it's probably not good for your body. But
exactly.
Call me crazy.
But there are many other ways to ingest all sorts of drugs, as John says. Drugs. Such a heavy term.
Well, according to the Federal Register, it is. So,
yeah, true.
Being the Federalist that I am, I'll stick to that.
Alas.
Bailey, what do you see happening in these markets?
I am not a doctor. Pretty flat right now. Obviously, S&P up 1/10%, Dow pretty much square on the nose. NASDAQ 100 incrementally higher. Looking at some of the weakness, though, Dish Network, ticker DISH, down 19%. When an analyst calls your results astonishingly bad, that is never good. So you're seeing a lot of selling pressure for Dish. And as JT mentioned, Bumble under pressure right now, down at 6.6%, ticker BMBL. That after founder Whitney Wolfe Herd stepping down as CEO, LaDiane Johnson coming from Slack will be succeeding her. But obviously, as JT mentioned, a number of changes across the C-suite, and you're seeing Bumble being hit to the downside off of that.
Bailey, we had a lot of low-quality rallying last week. The ARK Innovation ETF had its best week ever, up 19% last week. What does that tell you about the stock market right now?
Who are you calling low quality? That's what I want to know. But we are seeing risk on.
Well, heavily shorted.
Heavily shorted, the ARK stocks, the D-SPACs, the crypto-tied assets, as I know you pay attention to over on the CAT team. Just risk on rally, people covering their shorts, people maybe taking on a bit more risk with expectations that the Fed is going to pause and maybe we're going to see some cuts in 2024. Looking at the data, we did have kind of a double whammy last week. Fed talking it down on Wednesday, jobs number coming in, which was in line with what bulls were looking for. The funny thing is Apple results were actually pretty underwhelming on Thursday, but not enough to shake the market from its best week in over a year. So we do see investors flocking back to some of those riskier corners of the market. One thing that does come up on calls is be aware that a trend takes a little bit more time. So we do have a strong move over the last 5-6 days, but when you look at kind of some of the fundamentals, we still need to see growth, especially from an earnings perspective.
So, but we have seen better earnings than expected. I mean, we always do, right?
Talk down results and
yes.
Beat them, maybe.
We have seen rates come down substantially. We have seen dollar weakness. We haven't seen the oil patch acting up, so still $80 crude. Like everything looks good for the equity market, right? Still.
That's what it seems like. And again, you're looking at it from a seasonality perspective. We are going into the end of the year. It's November 6th. So you've got really 6 trading weeks, call it 4 though, with Thanksgiving holiday and going into Hanukkah, Christmas, and year-end holidays. November historically is one of the best that is based on the last 20 years, the third best month for the S&P 500.
The third best?
Third best.
Are you looking at SEAG?
SEAG, toggle that puppy to 20 years. We got 1 point. Obviously, that does include, disclaimer, 4.06% for November, I believe, is being tossed into that calculation, but only trailing April and July. So fourth quarter seasonally
So
strong.
I'm going out 29 years because
Ooh.
that's as far as I can make it move on my dashboard. And I see November as the #1 best month, better than April even.
Good times, good vibes, quarterly results. But again, the issue with some of the seasonality is you do have outliers that can drive that number. And that's one of the things that's been interesting looking at the start of the year. In particular, you look at the weakness across September, it's pretty much red going up and down the last 29 years. But I mean, Matt, thinking about it from a holiday perspective, if you're an investor, you want to get some profits, you're either going to sell some losers to tax loss harvest or go into a bit of a rally like Emily mentioned. Going into the year end, Santa Claus rally makes everyone on Wall Street happy in what's been a really tough 2-year stretch.
Yeah, absolutely. All right, Bailey, thanks very much. Bailey Lipschultz there, covers stocks for us from Bloomberg News. One of the problems I think that markets face right now is that we're always hoping for a more dovish Fed, and right now these markets are pricing in 100 basis points almost of cuts by the end of 2024, even though the dot plot showed us only 2 cuts, so 50 basis points of cuts. This market seems to have been fighting the Fed for the last 2 years at least. Let's bring in Liz Capo-McCormick, our chief correspondent for global macro markets, to talk about this. So Liz, why does this market always think on the way up they thought Powell was going to do much less? I'll remember forever Jeff Gundlach saying there's no way this Fed gets to 5%, right? So now at 5.5, the market thinks that the Fed's going to cut to 450, even though the dot plots are saying 5 even.
Yeah, it's funny. They seem to love to price these cuts in, right? And we've all done stories of how they've been wrong before. I mean, to be fair to traders, that's what they are supposed to do, be ahead, right? Like, think of what's the Fed going to do next. They can't just trade today. But yeah, that said, they've been kind of kept thinking we'd have a hard pivot sooner to easing. Now, like you said, it's about like 4 cuts they've got priced in. I mean, the Fed is going to stick with, we're not done. We haven't, beaten inflation until the bitter end, I think, because they don't want to already financial conditions are eased since Friday. But I don't think they're going to flag and, cuts are coming until the bitter end. But I think the market has gone too far again. Even like 2 dots, like give them 2 dots, but now we're double that, right?
By the way, Emily Graffeo first came to my attention when she wrote a great story about what financial conditions really are.
Yes.
Are they what we're watching? Is Jay Powell got something different on his dashboard? I mean, it's really important to point out, right, Emily? Because anytime the stock market jumps or bonds do, financial markets are easier.
That's right. And a lot of the indexes track very different things. There were some from, these big banks that have the VIX as 30% of what financial conditions are. And so we did a lot of work this year on the cross-asset team of discovering, what does that actually mean? But Liz, I want to ask you, to what extent do these bets that we're going to get a rate cut and loosening of financial conditions actually reverse the work that the Fed is trying to do?
Well, that's what I feel like me and Mike McKenzie are kibitzing at our desk all the time, that this is the problem. Like, if the Fed is leaning into higher rates and term premium and things like that we talked about, as doing some of their work, what happens when we get like last week when rates come down and, whatever metric you're looking at, financial conditions are easing?
If the answer is obvious, I'm going to say they have to raise rates again, right?
Well, exactly. That's what some people have said. Like, I forget who it was the other day said, this is like a dance the Fed doesn't want to be in, right? So I don't know. I think it's a precarious thing to lean too hard into higher rates doing part of their work and tightening financial conditions. We're going to have a stop it. Although everyone seems to have the mantra the Fed is done, right? But I guess now it's convincing the market for as long as they need. Inflation is still well above 2% target, that rates will stay higher for longer and that they're not going to cut. But I don't know. It's not working.
Part of me suspected like a deep state conspiracy this morning because Treasury has to issue so many bonds, and it would have hurt if rates had stayed so high. I thought maybe, Yellen and Powell were talking. But if Yellen and Powell were talking, then she wouldn't have made the biggest blunder in Treasury history, right? How do you think about the Druckenmiller-Yellen spat?
Can I be truthful here?
Yes, just between us.
Just between us.
Yeah.
I was saying that, just to be fair, that there was a Treasury Secretary before Janet Yellen, right? Stephen Mnuchin, under a different administration. They were part of it. They were coming in when rates were low. So I don't think it's
but we trust, Yellen is a genius. She's very intelligent.
But she didn't have as much...
She was the Fed chair. I mean, Mnuchin is like a Hollywood producer, right? So whatever, he flubbed it. But Yellen should have gotten it right.
Okay, so all right, I don't want to, I'm too opinionated on this. No, she could have extended the maturity even further. She said she did. I totally agree. The TBAC has said the U.S. can't sell 100-year bonds. We don't just sell one-off bonds.
Austria did it.
Okay. But I think you have to have stuff that you can sell over and over and have solid demand. And look at the 20-year that they've had a lot of problems with. That was a longer duration piece. So, I mean, drunken mind or whatever aside, I think, though, that some people did say what you said, conspiracy. I won't say what Wall Street notes to say. It almost looked like if you didn't know there were two separate entities, that the kind of Yellen tried to help out, on the other side, because she said, well, I'm going to lean a little bit away from long-end rates, which it seems like our supply is helping long-end rates go up, which is not great for the economy. And so I don't know, but I won't say who had the conspiracy theory.
We'll talk about it in the commercial. I don't know. When I saw Austria doing this, I thought, yeah, damn, that's awesome. The U.S. should do it too. If people are going to demand Austrian bonds, then they sure as heck are going to want U.S. government paper out 100 years, right? And that's free money, basically.
Right, but that's like a one-time thing. I mean, I'm going to be...
I'll take it.
You'll hold it to the end.
Emily, please bail us out.
Well, Liz, what are investors saying about supply? I feel like we've written so many articles, but I'm curious from your sources, the big PMs, are they concerned as much about supply as we
it's
are?
interesting. Like Greg Peters at PGIM has long said, and I think he likes me, he's nice, but that supply is really not it. It's really more about what's happening in the economy, the Fed. Jim Bianco has long pinged me, Liz, I don't think it's about supply. He thinks it's about structurally higher inflation sticking around and higher rates for longer.
By the way, when we say supply, that's like a nice way to say deficit spending and debts, right?
Right.
Okay.
Me, from my days of wonky, MBA school, feel like I always say we were learning about the deficits back then was a problem. X years later, I won't say how long, we still have this deficit problem. It's getting worse. So I do think that it's an issue, that the supply is an issue. I think investors, for their portfolios are looking at a lot of stuff, but you kind of have to say term premium went up. That's got to be part of it. It's a wonky metric, but part of that supply demand. I was just looking at JP Morgan's team did their post-refunding thing, and they're like, okay, Treasury leaned off the long end a little, less supply a little bit than we thought, but, they were looking at their kind of supply, if you look an equivalent, like if it was all 10-year notes, next year's note and bond supply is going to rise by like 21% versus this year. So supply is still going up and up, because what I see in Washington is no one really working on the deficit. It doesn't seem like...
No way.
No.
No.
Yeah, that we agree.
No, I mean, next year... debt servicing costs are going to be $900 billion. We're going to spend $1 trillion essentially on debt servicing.
Yep.
And to me, the worry is that doesn't leave enough for funding like cancer research or military defense. I mean, these things are going to start becoming a little bit more expensive.
Yeah, we did a little bit ago a big take on that, and that's what someone was saying. This isn't good spending that's building roads and bridges, helping to cure cancer or whatever. We're just like you and I, if we had a big debt, and we're like, oh my God, I just costing me hundreds a month just to pay the interest on this debt. I can't send my kid to college or what. I mean, that's extreme cases, but no, I think it's a problem. I hope something changes. We have a new election next year. Who knows what's going to happen? But so far, right now, I don't see too much of, spending cuts, tax increase. Nobody wants tax increase.
No, taxes have been increased enough.
Yes, exactly.
At some point, that's what's going to get people's attention, right? Yeah. Because the numbers don't make any sense. We're numb to what's $1 trillion, what's $2 trillion. Nobody knows what that is. But when my tax rate is like eclipsing 46%, I definitely feel that. Liz Capo-McCormick, Global Macro Markets Chief Correspondent for Bloomberg News, thank you very much for coming in.
Thank you.
With me and Emily Garifeo. Joining me for the hour as Paul Sweeney kicks off a long, boozy lunch. This
Celebrating the Duke win.
is Bloomberg. Let's get over to Steve Rappaport right now. He's here with your company news. Steve?
Matt, Tyson Foods is recalling nearly 30,000 pounds of its breaded chicken Fun Nuggets. Bloomberg's Lisa Mateo has more.
Steve, Tyson pulled the dinosaur-shaped patties after consumers complained of finding metal pieces in them. The nuggets, sold in 29-ounce bags, were produced September 5th by Tyson. The Arkansas-based company informed the USDA about the problem and said it recalled the nuggets voluntarily out of an abundance of caution. The affected products carry the number P7211 on the back of the package. The USDA urges consumers to throw the nuggets out or return them to the place of purchase. Steve?
Thanks, Lisa. Tech giant Alphabet is facing off with Epic Games at a trial this week in an antitrust case targeting the company's control of its Google Play App Store. Bloomberg's Charlie Pellet reports.
Steve, the showdown in San Francisco federal court threatens billions of dollars in revenue generated by Alphabet's app marketplace. In a lawsuit filed 3 years ago, Epic claims Google has monopolized the Android app distribution market for more than a decade by striking side deals to pay off rivals and uses its vast resources to snuff out all competition. If Alphabet loses, it could be forced to open the door for payment and app distribution methods outside its own app store. Epic, the maker of the popular Fortnite game, largely lost a similar challenge 2 years ago to Apple. Steve?
Thanks, Charlie. And Starbucks says effective January 1st, eligible U.S. retail hourly employees will see an incremental pay increase of at least 3%. And those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. We are slightly higher for the major averages. Some investors do remain skeptical over the Goldilocks scenario. They think the recent gains may be more reflective of bear market rally than the onset of some sustained upturn at this point. They're citing worries over a weaker earnings outlook. Among some of the stocks on the move today, Berkshire Hathaway, one of the biggest individual drags on the S&P 500. That's based on the index points. Also, a gloomy outlook from banks that could raise the probability of recession. That could also cause stocks and short-dated bond yields to fall later today. Senior Loan Officer Survey, that's out today at 2 p.m. Wall Street time. So keep an eye out for that. S&P